Show The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, trade tensions weighing on stocks this morning. The EU vowing firm countermeasures to any tariffs imposed by the U.S. after President Trump implemented his 25% tariff on all steel and aluminum imports, with the warning that metal levies may go higher. Gold hitting another record high following the increase in trade tensions, but slightly pulling back this morning.
Plus, traders awaiting commentary from Fed Chair Jay Powell, who is set to deliver his semi-annual monetary policy report to Congress. The Fed chief will face questions on both sides of the aisle as Democrats and Republicans will focus in on the impact of Trump's policies, ranging from bank regulation to a rollback of DEI efforts.
And earnings season continues. Results, they're out this morning from Coca-Cola, showing quarterly earnings and revenue topping analysts' expectations as global demand for its drinks rose. Meanwhile, Marriott reported fourth quarter earnings that beat expectations. The hotel company expanding its global network of hotels at a rapid U.S. futures are under pressure this morning after President Trump signed orders late Monday to raise tariffs to 25% on steel and aluminum. The EU vowed a firm and a proportionate response here. European Commission President Ursula von der Leyen saying in a statement, unjustified tariffs will not go unanswered, end quote. Joining us now, we've got Peter Harrell, who is the former White House Senior Director for International Economics under the Biden administration and current non-resident fellow at the Carnegie Endowment for International Peace. Good to have you here with us, and thanks for taking the time this morning. Just walk us through how you're kind of running the calculus around the tariffs imposed by Trump and now the response that has been also made public by the EU.
Yeah, well, thanks for having me on this morning. And obviously a significant development last night with the president's announcement that he's imposing 25% tariffs on effectively all U.S. imports of steel and aluminum from all countries around the world. This obviously builds on the tariffs that he implemented on China just over a week ago. So, he ran for election threatening a trade war. We are now absolutely seeing the beginnings of that trade war play out. I think with respect to the action he took last night on steel and aluminum, I want to make a couple of points. First, in some sense, we've been there before. He actually first imposed tariffs on steel and aluminum imports back in 2018. And so in some sense, he's just building on what he had done before. But second, consistent with his overall trade policy, what he's did last night is actually quite a bit more aggressive than what he did during his first term. During his first term, he had steel and aluminum tariffs, but he cut deals with some countries like Canada and Mexico to allow those things to come in tariff-free. And then he also had an exclusions process where companies could come in and say, hey, I can't find steel somewhere else. Can I import it without the tariff? That's all gone. This is truly universal tariffs with no exclusion. So quite a bit more aggressive than what he had done in the first term. Second, we are going to see retaliation out of Europe. The European Union had retaliated when he first imposed tariffs during his first term. Biden struck a deal with the EU where those retaliatory tariffs went back. The European Union, we saw European Union President von der Leyen say last night, those retaliatory tariffs are coming back. Now, I've talked to folks in Brussels. I think Brussels would like to negotiate a détente there, but if Trump doesn't show interest in a deal, we're going to see European tariffs on American goods like distilled spirits, like motorcycles, like, iconic American clothing like Levi's jeans. So I think we're going to be in for some friction over the coming weeks.
Peter, when it comes to how much this strategic, or does it at all really structurally change the U.S. economy? Because President Trump and the Trump administration making the argument that they want to bring more jobs back here to the U.S., they want to further bolster the U.S. economy here by doing so. Can they reverse that declining market share and the stagnating production that we've seen for so long when it comes to the U.S. economy?
So if I look just on steel and aluminum, if you look at some of the economic analysis that was done around his first term tariffs, they did bring back a bit of steel production in the U.S. On the other hand, they actually drove up the cost of steel in the US, which then hurt other manufacturing industries. And so you saw less growth in those other manufacturing industries. And I think one of the challenges companies are going to face right now that are buying a lot of steel, for example, to build, new car factories in the US, new bridges in the US, new semiconductor factories in the US, they're now going to face higher prices. So I think this may be good for the steel industry, for US steel jobs, less clear that it's going to be good for other kinds of manufacturing jobs that depend on steel. And I think that raises a broader question about just how effective these tariffs are going to be at actually rebuilding manufacturing writ large, as opposed to maybe rebuilding manufacturing in a couple of selective sectors.
Peter, how much disruption can the U.S. economy handle at this point?
I mean, President Trump has a lot of economic tailwinds at his back, right? We've had strong economic growth numbers over the last couple of quarters. Consumer sentiment has been okay. We are seeing a little bit of, slowdown in hiring and those kind of things. But obviously there are some strong structural tailwinds at the president's back. And so I think that the economy can weather, a little bit of a Trump economic tempest here. But if this expands beyond a little bit of a tempest into a full-blown kind of global trade war with a lot of other geopolitical uncertainty, that's the kind of thing where I think you might begin to see impacts on the top line numbers.
And Peter, I guess that's part of the concern. If we see this go from tempest to tantrum and even more of the trade war kind of spillover, what do you believe that means for inflation, where the Fed is already standing by just to see exactly what type of ingestion takes place within the economy through all of the trade war and the tariff talk and implementation as well?
Yeah, I think we need to be very clear that at least in the short and mid run, tariffs are inflationary, right? These are paid by U.S. companies importing the goods. And, we saw that last week when people were beginning to see tariffs on some of the imports from China and certain electronics and things like that, now costing 10% more than they did a couple of weeks ago. And we're going to see something similar on steel and aluminum. Now, so far, the value of the products that are being tariffed compared to the size of the U.S. economy, pretty small. We import, a couple tens of billions of dollars of consumer electronics from China every year. We import, some billions of dollars, 10 to 20 billion, I believe, steel every year. Macroeconomically, these aren't numbers that are going to move top line inflation. But if we start tariffing the world, at 10, 20%, when we're importing $3 trillion of goods a year, that is where you're going to begin to see some inflationary impacts. And that's why we've already seen Chairman Powell, talk about the fact he's looking at policy developments as he thinks about the future direction of rates.
Peter Harrell, really appreciate you taking the time. Thanks so much for joining us here this morning.
Thank you.
The growing trade war sparking some caution among investors today, but with the S&P 500 trading within 1% of its record high, are investors being too complacent on trade risks? Goldman Sachs strategist led by David Kostin estimating that for every 5 percentage point increase in the U.S. tariff rate, S&P 500 EPS estimates would decrease by about 1 to 2% this year. The estimated EPS growth rate, that would shrink by approximately 1 percentage point. Joining us now to discuss is Cameron Dawson, New Edge Wealth Chief Investment Officer. Cameron, it's great to see you again. So let's talk about the threat maybe that this poses. Is this a threat to the bull market?
It certainly could be a threat if it starts to hit corporate earnings estimates. We think the most important thing that has driven this bull market over the last 2 years is that 12-month forward EPS estimates have continued to climb higher. And so if you start raising doubts that that is capable of continuing to happen, that's where you start to see the potential for a more sideways, choppy, volatile market, which is just to say, if 12-month forward earnings estimates level off, equity returns will also level off. And so we think what's really interesting is that even though fourth quarter earnings season has come in better than expected, you went into the quarter expecting just 12% growth. Now you're running at about 16% growth. Analysts for 25 and 26 have actually been cutting their numbers just slightly. It's only 1 to 2%, so it's nothing to necessarily make you very scared, but it's definitely a change from this ever-rising estimate revision higher, which has, of course, supported the rally.
Yeah, Cameron, I was reading a note from UBS this morning. They're maintaining, of course, their base case for the S&P 500 to reach 6,600 by the year end, but it seems like there's also a little bit of trepidation among some of the risk trades, the risk assets out there. So with this propensity for hedging, can we still reach some of those targets?
So our base case for 2025 is a wide, choppy range, which is to say that, yes, you can reach that 6,600 level at some point over the course of the year, but it's also likely that you could experience a 10% correction. So we've been arguing to our clients that it's far less important where you end the year in 2025, far more important what you do with volatility along the way, because we do think that this environment of big policy uncertainty that is coming to terms with the fact that, to the point of complacency, you have very high valuations, you have stretched positioning, you have stretched sentiment across the board. All of that leaves very little wiggle room for downside surprise. So we think that, yes, we can get good returns over the course of the year, but be prepared as well for volatility, which is likely to strike because of these high expectations.
And Cameron, when you take a look at the strong dollar, I guess how much further does that then complicate the picture here for multinationals?
Well, it certainly can weigh on revenue growth. And we thought that we would hear this a little bit more coming out of earnings season, effectively companies using the strong dollar as a scapegoat to talk down revenue guidance. But that certainly is a wild card. If we look at the dollar, what we can see is in positioning that there is a very long dollar positioning trade that's been put on, which is just to say that everybody is already betting on a stronger dollar. And what we typically see is that when dollar positioning is as extended as it is today, you have seen normally local peaks in the dollar. So that's something certainly to watch. From a technical perspective, though, the dollar is trading above its 50-day moving average. It's holding that support really well. So nothing to say necessarily technically that there's expecting a weaker dollar in the very near term, but watch that positioning closely.
Cameron, our viewers know very well by now that I love a good brunch, and it seems like all people want to talk about at brunch is DeepSeek and any type of impact that DeepSeek and these other tariff adjacent conversations where there are technologies that could be leveraged as negotiating pawns essentially get ratcheted into the market psyche. How are you kind of now analyzing and running calculus around those risks in adjacency with tariff talks?
Well, I thought at brunch we would talk about the very high egg prices, but certainly with DeepSeek being a question about the efficacy of CapEx growth within the U.S. tech complex. One of the things is that we've seen huge CapEx spending by the Mag 7, which of course has benefited other Mag 7 names. And are we starting to get to the point where investors are losing patience with this degree of CapEx spending? And we do think that that is one of the reasons why we've seen some deterioration in Mag 7 relative performance over the course of the last month or so. It has lagged as we've gone into 2025. And we think it's because investors are starting to ask the question, what is the return on invested capital for all of this spending that they're doing, where you're seeing a lot more competition within AI, which is very much in contrast with these near monopoly businesses that is the core bread and butter of the Mag 7. So we do think that this raises the question of those ROICs and is likely why we're starting to see that Mag 7 lag.
Cameron, in just about an hour, less than an hour from now, Fed Chair Jay Powell is going to begin his testimony here on Capitol Hill. I'm curious what you will be closely listening to when it comes to tariffs, when it comes to the fight to tame inflation, even in reaction to the jobs report that we got out last Friday. What's top of mind for you?
Well, we don't think Powell will say much. We think he's probably listening to country music with the song "You Say It Best When You Say Nothing at All." Effectively to say is he does not want to provide any political fodder for what the next decision from the Fed is going to be. He's probably not going to want to address whether or not he included tariffs in his estimates for the SEP. Of course, there's this big question of how much policy was reflected in the expectations for weaker growth and higher inflation, inflation when we got that December SEP. So he's going to try to kind of steer away from that at the same time as really deliver a message of patience. And we heard that from Fed members already this week and last week, which is just to say the job market is not giving them reason to need to cut aggressively in the near term. Inflation still remains above their target, all just suggesting that they have the room to remain on hold and not have to react too quickly to some kind of sharp weakening that's around the corner.
Well, hopefully he's got some Chris Stapleton in that country music playlist that he's got going into this hearing. Cameron, thanks so much for taking the time here with us.
Thank you.
Gold prices hit all-time highs in the past 24 hours amid fears of a global trade war. President Donald Trump's tariffs on steel and aluminum sending prices of the precious metal above $2,900 an ounce. Yahoo Finance's Inez Ferre has more. Hey, Inez.
Hey, Brad. Yeah, and gold has now hit 8 all-time highs in 2025. Year-to-date, gold is up 10%. As you mentioned, investors really flocking towards the safe haven. You have some structural changes when it comes to gold over the last year. Over the last several years, you've had more central bank buying. Last year, you had all-time high demand for gold, ETF buying as well. So really right now, what we're seeing is that we're looking at that $3,000 level in sight. The question is whether we get a reversal beforehand. Wednesday's inflation print will be very important because gold is considered a hedge against inflation, but higher rates, if the Fed decides to continue with higher rates for longer, then that is not as appealing towards this non-yielding asset. So tomorrow's inflation print will be important. Chair Powell's testimony as well will be important to take a look at what happens with gold. But certainly this has been the safe haven most favored by investors recently.
And as also, let's take a look at oil because oil prices also moving to the upside despite some of those tariff risks. What do you make of the climb? And I guess what you're hearing just about maybe how high we could be headed.
Yeah, there's a couple of issues that are at hand here when it comes to oil, because over the last several sessions, we've seen that oil has been reversing its 3-week decline that we had seen recently. So you've got a couple of factors. Russian sanctions that are impacting flows. You have Russian oil that is being shipped to China and India. That's been impacted by the latest latest U.S. sanctions against Russia. Whereas before the sanctions against Russia, they could kind of get around those. These are more difficult to get around. The other thing is the Iranian supply concerns because of U.S. imposed sanctions on Iran. They're very limited, but still, nonetheless, this creates jitters about the flow in the future of Iranian oil. Trump has talked about maximum pressure against Iran. Countering this, as you mentioned, the tariffs. So this could be setting a sort of cap on these prices. But right now, it looks like there is a reversal of the trend. Oil was in a bearish trend. We are starting to see a little bit of a reversal. And what will be important in the future is what OPEC decides to do, what the oil cartel decides to do, because there's some analysts that are saying that OPEC may extend again its output cuts, guys.
All right, Ines, thanks so much. As we head to break, let's take a look at Meta shares coming off a rally of 16 straight sessions, the longest streak of any current Nasdaq 100 index company going back to 1990. The stock adding more than 17% over that time frame, bringing its market cap to just above 1.8 trillion. Again, though, take a look at today's action here ahead of the open. You are looking at some losses here, off just about 0.5%. Also, Meta in headlines here this week as the company begins laying off some of its workers. Again, largely expected here when it comes to those performance-based reviews, the story that we have covered here for the last several weeks at Yahoo Finance. But again, Meta coming off of 16 straight days of gains. We'll see whether or not they can reverse here in today's session. We'll be right back.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Coca-Cola topping fourth quarter estimates with net revenues up 6%, boosted by higher prices and steady demand. The company issuing full year guidance, expecting organic revenue growth of 5 to 6% here. You're taking a look at shares, pre-market up 4%. The CEO and chairman James Quincy saying their global scale, coupled with local market expertise and dedication of their people system, uniquely position them to capture the vast opportunities ahead here. And it is in a drinks market that has undergone a lot of changes, whether that be in making sure that the consumer appetite, especially among newer and younger consumers, which skews more sans sugar, if you will. That has specifically been one of the areas where soft drink manufacturers have been trying to make sure that they maintain market share in a changing consumer taste environment.
Yeah, certainly. I think when you take a look at Coca-Cola's business right now and some of the numbers, they clearly are up against a challenging macro environment. But I think when you compare it to some of the results that we have seen from competitors like PepsiCo, very much they stand out among the consumer staples. And that was the big takeaway that I saw from the analyst roundups that I was reading this morning. Truist was out saying that Coca-Cola looks like one of the safest plays, what has become a minefield of challenges for the broader consumer staples group. A lot of that due to tariffs, talk about FX headwinds, GLP-1 factor as well. So again, Coca-Cola best positioned amongst the group. In the earnings call that just got underway a few minutes ago, CEO James Quincy was talking about some of those macroeconomic pressures. When you talk about inflation, obviously still being a huge challenge here for so many consumers, saying that the lower income bracket here in the U.S. and also in Europe, shoppers there are under pressure. That's having an impact on the business here going forward. But we know Coca-Cola has been raising prices now for several quarters. Those price raises able to offset some of that volume pressure that we have been seeing. So again, well positioned amongst that group. And that's a big reason why we're looking at shares up just about 4% here this morning.
Absolutely.
All right, let's take a look at Marriott reporting better than expected fourth quarter results. The hotel chain expanding its network, the company increasing its room count by 123,000 in 2024, bringing its total to 1.7 million rooms globally. But again, you're looking at pressure off just about 3%. And here's why. The guidance did not meet expectations. The Q1 guide, the unit growth, a bit of a disappointment there. That's why we're seeing the pressure on the stock here this morning, off just about 3%. So again, there was a lot to like in this report. But when you take a look at the current trends right now, maybe what some of that spending levels could potentially look like here for Marriott in the first quarter, in the current quarter, that Q1 guide weighing on the stock here this morning.
We're looking at some massive capacity pipelines for all of the hotel operators and accommodations operators right now, really trying to continue to stave off competition from some of the of course, Airbnbs of the world and Expedia and their ownership of Vrbo. All of these things considered, they're trying to make sure that they rapidly add more rooms, and Marriott doing just that as well. Record gross room additions in this most recent quarter, or most recent year, I should say. 123,000 rooms added to their coffers here in 2024. Net rooms grew 6.8% from the end of the year in 2023. This kind of mirrors what we had already heard from Hilton this earnings season as well when they were talking about their pipeline. That pipeline from Marriott right now totaling nearly 3,800 properties and 577,000 rooms that are still going to be coming online in the near future as well. Also here, we got to talk about this one this morning. BP announcing plans to reset its strategy after missing fourth quarter expectations. The oil giant also announcing a $1.75 billion share buyback program. This comes as activist hedge fund Elliott Management has reportedly built a stake in the company and is pushing for changes here. And of course, these are a few of the things that we're tracking around this ticker, down right now by about 0.4% here going into the start of today's trading activity. And it also might go to show where the activist campaigns really have a lot of legroom to be successful, at least earlier in the year, in making some of their cases known for companies that have underperformed expectations to this point.
Yeah, certainly. We first reported this yesterday, just the interest here from Elliott Management. We know they are very effective. A lot of times businesses very much listen when they are under pressure here from Elliott Management. So not necessarily a surprise, some of the strategic changes that are being laid out here from BP. And it's also important to point out that BP is not the only target. There was also the reports out this morning. Elliott Management has now built a $2.5 billion stake in the oil refiner Phillips 66. What are some of the changes that they're looking for there? They want to simplify the refiner. Reportedly, they plan to push for the company to spin off the midstream business, of course, as they look to further strengthen their balance sheet and also better position the company down the line. We're seeing a bit of a reaction here in a Phillips 66 shares this morning. You're looking at gains of just about 4.5%. So we know Elliott Management very much is effective. A lot of times when they do go after these companies, target specific companies across industries, they do typically invoke some sort of change, whether or not that is any sort of management changes, whether or not that's strategically driven. Obviously, that remains to be seen, and what exactly the impact is going to have on BP and on Phillips 66. But again, you're already getting BP responding to these efforts. And of course, this comes after years of underperformance.
Yeah, that underperformance, just to put a number on that, over the past year, BP shares down by about 5.5%. Think about XLE and the broader energy sector. It's actually up by about 7% over that period of time.
All right, keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Counting down to opening bell here on Wall Street as investors digest a slew of earnings that were out this morning. Also, new tariffs imposed by the Trump administration, trying to figure out and calculate just the impact that is going to have, not only on the markets. Very much investors seem to be shrugging that off for now. But the big question is whether or not the market is a bit too complacent when it comes to President Trump's tariff plans. Of course, also as we look ahead to Fed Chair Jay Powell's testimony on Capitol Hill here in just about 30 minutes from now. That will be a big focal point just in terms of any insight into Fed policy and how they are thinking about some of the policies coming out of the Trump administration. So as we do kick off today's trading day, let's take a look at some of the action that we are seeing here for the major averages. We aren't too far from the flat line. You've got the Dow off just about 0.2% here this morning. You are looking at the S&P pulling back just a bit, still above the 6,000 level here, but off just about 0.3%. And also when you take a look at big tech, some of that selling pressure there going on within the Nasdaq, you've got the Nasdaq off just about 0.5%. Flipping down here to the bond market, some of that action that has certainly been a driver here as of late. You've got the 10-year yield up just about 4 basis points to 4.54. So again, above that 4.5 level that we have closely been watching. The dollar index pulling back just a bit here this morning. Let's take a look at the sector action here at the open ahead of the testimony from Fed Chair Jay Powell. You're looking at energy and materials, the outperformers here of the session, followed by consumer staples. We got the report out from Coca-Cola, better than expected. Very much we're seeing that stock pop here in early trading. You're looking at consumer staples amongst the leaders here in today's early action. On the flip side, you've got discretionary, utilities, communications among the worst performers here on a sector basis. Inside the Dow here, you're looking at a mixed picture of some of those larger cap tech giants. You got Microsoft, Nvidia in the red here this morning. Amazon right around the flat line, I should say. Apple up just about 1%. And when you look a little bit wider here at this broader picture of some of that movement that we are seeing here this morning, again, Coca-Cola, I just said, was out with earnings earlier this morning. You're looking at gains here at the open as that blanks out, but gains at the open, take my word for it, it's up just about 4%. Let's kick it over to Yahoo Finance's Jared Blickery for a closer look at some of this action. Jared.
Thank you, Shauna. I want to go back to the major indices and just show how we are kind of just consolidating near highs. I'm going to show you a 3-month chart of the S&P 500, and you can see since early December, actually, we've just been tracing out this rounded bowl. If you look at the Nasdaq, it's slanting down a little bit, but very similar situation. And the Dow is kind of an outlier here, but potentially it has its own pattern here, and we've been tracking sideways action for the most part in the indices over the last 2+ months. And so what is going to be that next catalyst? We don't know, but we do have some inklings as to which sectors will be affected, and that's because we've had new leadership taking place since the inauguration. Shauna touched on the 10-year T-note yield and dollar situation, which I'll just hit really quickly. Yields are up, so 4.54%, 4 basis points isn't nothing, but it's not a danger until we get to about 4.75%, much less 5% all the way up here, which we haven't seen in years. That's what we want to keep in mind. So not anything to be too concerned about today. Dollar just treading water, as we can see there. I think it's interesting in the sector action, speaking of that, is that the 3 mega cap sectors are all in the red today. That would be consumer discretionary, tech, and communication services. They have not contributed nearly as much as they have in the past, and that's because the Mag 7 have not participated as much this year. Now, currently, utilities are leading down while we have energy and materials leading up. But I want to get to the Nasdaq 100, where I have a sad story about Meta, which is now snapping its 16-day winning streak. That was a streak that hadn't been seen by any other Mag 7 stock in history. And I'll just show you the 1-year chart, and you can see how, as of late, Meta just really took off. And you might have to take my word for that. 1-year chart not populating right now, but I do need to get to the futures market because we have some other streaks in danger there. First is not a streak story. This is gold. Gold nearly hit, oh, there we go. There's gold. Nearly hit $3,000 an ounce and backed off of that just a little bit. This is going to be an intraday chart. There we go, right there. And then we were tracking that 6-day gain in copper. Well, that is reversing now. And finally, I'm going to leave you with coffee, which is reversing a 14-day win streak. And here's the year-to-date price action. You can see still holding on to gains of 24%, but coffee prices have been skyrocketing recently.
Jared, thanks so much. Bad news for my morning coffee, I suppose. Thanks. Time now for today's strategy session. We're taking a quick look at the mixed picture for several U.S.-listed Chinese stocks this morning as investors weigh the impact of fresh tariffs ordered by President Trump overnight. Hong Kong stocks dropped from a 4-month high as fears of an all-out trade war grow. Where do negotiations go from here, and what does it mean for the two economies in the meantime? Joining us now, we've got Brian McCarthy, MacroLens chief strategist, and not just the two economies, of course, the two largest economies in the world by GDP here. So into your evaluation of how we're seeing the trade tensions play out early innings right now, where are some of the most exposed equity market plays as of this juncture?
I think your colleague used the term complacency regarding what's going on with tariffs in general. I think the U.S. Equity market is terribly exposed to what's happening. You have President Trump coming in and aggressively closing the border. That inflicts a supply shock on the U.S. economy. At the same time, he's in a dogfight in Congress simply to extend the 2017 tax cuts. If we remember, in 2017, he came in within a year. They cut the corporate rate from 35 to 21, and now they're just hoping to extend that. The cost for extending that is going to be $2 to $2.5 trillion in spending cuts to keep fiscal conservatives in the House on board. So you've got a tightening there on net. To overlay this with another supply shock in terms of aggressive tariffs is incredibly risky from an economic policy standpoint and potentially from the standpoint of the president's political capital, which could bleed pretty quickly if the economy turns south. So, to turn to China, I'm somewhat surprised. It looks like the 10% on China is going to stick, but there is so much going on the tariff front elsewhere that the market seems to almost have sort of fallen asleep on the fact that we are in the early stages of a simmering trade and tariff war with China.
So, Brian, what does that downside risk then look like from here?
I should also mention, if the economy starts to turn south in response to these what look like dual supply shocks of cracking down on immigration and imposing tariffs, the Fed is in no mood to accommodate that. A number of FOMC members have suggested that coming off the high inflation we've had, they're going to, look critically at any price pressures coming from these, cost effects from immigration and tariff, which is another problem for this policy cocktail. So I would go so far as to say I think the highs are in for U.S. equities, and the downside is pretty considerable if President Trump's his bite turns out to be as bad as his bark has been on these tariffs. The next question, obviously, is what does he mean by reciprocal tariffs? What's that going to look like? Could be extremely complicated and pretty onerous if he follows through on some of the things he's hinting at.
So we're talking about 5% drawdown, 10% drawdown?
Oh, if the economy turns into recession and the Fed isn't quick to respond, 20% easily. That's sort of a standard, recessionary downturn.
But Brian, how likely is that, though?
The Fed puts a long way away right now.
Yeah. But how likely is that, though? Because very much the markets read, and like we started the discussion, whether or not we are just brushing aside some of those fears, right? And the market very much is viewing this as a negotiating tactic. I guess, what is that then tipping point that no longer it shows it, and we start to see maybe the truer hand potentially of the Trump administration, depending on how this plays out?
Sure. To be clear, 2 or 3 weeks ago, I was in the negotiating ploy camp. It did prove to be a negotiating ploy with regards to the 25% tariffs on Canada and Mexico. But as I said, it looks like the 10% on China is going to stick. At some point, there will be some discussions about what comes next there, but it looks like, nothing good coming out of that relationship anytime soon. I think the trigger could be these, let me just say last night's announcement on steel was more aggressive, steel and aluminum more aggressive than expected. It's picking up some downstream products, and it looks like there will be no exemption process at this point. So if there's something substantive comes out on these reciprocal tariffs, the talk is he's viewing the European VAT tax as a tariff that needs to be offset. So, this kind of thing, we have no idea what this reciprocal thing looks like at this point, but there are some versions of, how you would interpret that are pretty aggressive. I think that will be more than the market can bear. I think that will be the turning point at which we say he's not just negotiating here, he's actually kitchen sinking the populist agenda, which in the end is about rebalancing the playing field in terms of labor and capital, not good for capital.
Brian, I only got 30 seconds. To what extent do you think this impacts American companies' ability to sell into the region?
Again, the things with China are on a sort of a simmer right now. If that picks up, China is, the Wall Street Journal reported today they're already developing a laundry list of ways they could hit U.S. tech companies. The usual suspects would be in the crosshairs. They, a little shot across the bow of Google recently, NVIDIA, same, not substantial yet, but they're signaling, we can do things that can really hurt the business that U.S. multinationals do in China. Apple's at the center of that, and are vulnerable if this sort of goes off the rails. So, China's sort of a separate issue. The reciprocal tariffs, I think, are a big macro problem. And then probably by April 1st, when the president's series of reports he's requested on U.S. trade come through, we'll get better clarity on whether he's going to do a deal with China and sort of sideline that fight for 2026 or 2027, or whether he's just going to, sort of go for it on all fronts. It's just really not clear at this point.
Brian, thanks so much for taking the time. Appreciate it.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at the talk of the town on earnings calls. Maddie, I have a feeling I know what you're going to say.
Well, I love to do a Command F word count on these earnings calls, Brad, and we are hearing a lot about tariffs these days to the tune of 252 mentions on earnings calls. This is as of February 9th, so a couple of days ago. And obviously earnings season is not over yet, so we could see that number increasing further. But you can see just the huge lift here in mentions of tariffs specifically on earnings calls. So what does this tell us? Obviously executives trying to get ahead of any potential headwinds to come, training the market on this idea that they might be impacted by tariffs moving forward. But I also take a look at what Goldman Sachs' David Kostin has been saying. He's been talking about the potential of a 2 to 3% gain on S&P 500 earnings per share to come from tariffs. And by the way, that's only the tariffs that have been announced so far: Canada, Mexico, China. That's not including any potential tariffs on the EU. And the reason behind that is because these exact companies mentioning tariffs on their earnings calls, they have two choices with tariffs. They can pass the cost on to consumers who could potentially rebel and then not purchase as much from those companies, which would pressure margins, or they could eat the cost themselves, which would also pressure margins. So it puts them in a difficult position moving forward here. The question, of course, how much that will actually impact the market. If you take a look at the S&P during Trump's first term in office and look at the totality of days where the market dropped on days where he announced tariffs, it totaled about 5%. So not a significant drop, particularly when you take a look at the long-term market performance under Trump 1.0. And again, the potential positive here, Kostin pointing out, we could see valuations coming in off the back of any dips here. And of course, that has been a huge concern of the market. But we will just have to see tariffs versus valuations, which comes out on top for the market this year.
Maddie, thanks so much. As we head to break, let's get a check-in on shares of Humana. The shares are falling. The health insurer forecasted revenue, though, for 2025 that actually exceeded Wall Street's expectations, and it reported an adjusted loss per share for the fourth quarter that was better than the average analyst estimate. We've got much more ahead on Morning Brief.
Investors anticipating a more business-friendly environment under President Donald Trump with less regulation that could spark a resurgence in the IPO market. The U.S. IPO market had stalled post-pandemic, with U.S. companies raising just $32 billion in traditional IPOs last year in 2024. That's according to the latest data from DealLogic. Now, robotics company Micropolis begins trading today. You also have Aardvark Therapeutics going public this week, as well as cybersecurity firm SailPoint rounding out the week as the biggest IPO is set to go public on Thursday. Joining us now for the State of the IPO market, let's bring in Jim Neeson. He's the managing partner at the Connor Group. And Jim, I think the big question here for investors, they went into this year very optimistic that we're going to see this deal pipeline certainly surge or come back to life to some extent. We're starting to see signs of that. How much better is it going to get?
You know, I think it's going to get a lot better. We're really calling it IPO spring. I think you had 2 years where you had winter conditions. A lot of companies were really sort of in the gym around profitability and growth, getting ready for it. There's 1,400 unicorns around the world that are getting ready for IPOs. You also have private equity and venture capital that need to sort of create the flywheel of liquidity. A lot of companies are getting ready. 25 and 26 are going to be hot.
And so with that in mind, I mean, it really goes to show how many companies were just waiting in the pipeline to try and get a sense of not just moving through the election, also trying to get a sense of what the deal-making environment would be like and investor appetites right now. When you've got a market like this that these companies would be entering into, what do the discussions sound like that are playing out as they're certainly looking for investor appetites to be high for some of these companies who have yet to turn a profit?
Yes. You know, I think for a lot of companies, they want to make sure that the business is strong. You have to have a growth story that's quite important. I think now in the time of AI as well, you got to sort of have an articulate AI message, but where it's not jargon filled, where it's sort of like, hey, this is what I'm looking to do. I think also there's a lot of sort of testing the waters out there, meeting investors, sort of doing, getting ready for your roadshow, but you really want to make sure that people understand your business and they kind of come in and they want to grow it for the long term.
How have your conversations changed just with business leaders, CEOs that are thinking about going public? I guess, what is top of mind for them now?
I think the biggest thing is being opportunistic. So you have to be ready. An IPO is a 12 to 18 month type of journey. You got to get ready. It's sort of like getting your house ready for sale, right? The foundation has to be strong and you have to make sure it looks really good. That's the discussions that people are having. How do I invest money in my business to make sure that I'm really ready? Because a lot of times there's going to be long poles in the tent.
And so with that in mind, what are you expecting of the receptions and how companies are able to effectively communicate their story to the street and their pathway as they're now going to be entering into the cadence of quarterly reports and having to continue to give investor updates? Yeah,
it's a new discipline. I think there's a lot of new behaviors that organizations have to create of how do I run my business, how do I work with my customers, but how do I understand and get visibility for the future forecasting? A lot of companies, that's where they struggle. A lot of companies might miss earnings that first quarter. So you really have to make sure you got the people, process, systems, that you understand your business so you can articulate a message to the street.
Are you expected to see any sort of difference or just sort of, I guess, more activity in one sector than the other? And what does that signal just in terms of how investors are thinking about those top investment priorities?
Yeah, I think what's exciting about the markets being at all-time highs is there's multiple sectors that are going to be hot. 3 I'll sort of note. First, around the IT space, maybe AI, cloud computing, cybersecurity, a lot going on there. It's probably maybe a third of the companies in the pipeline. Second is healthcare, biotech, value-based care, med device. That's the longevity traits of our population. And then the third is I'd call growth industries. E-commerce, consumer products, as well as energy, those are going to be hot ones. So I think what's nice is it's broad-based.
We only got 30 seconds here, and I used to love working on the IPO business back in the former days, but you rarely ever saw a company come back from being private, would be previously public, go private, or get taken private, and then make a reboot public offering, if you will. We're going to see that with SailPoint. Why do you think that is right now?
I think the playbook has changed, especially with private equity. Private equity has trillions of dollars of dry powder. That's their playbook. Get great companies, buy them, take them private, make them more profitable, put more revenue in, and then take them public again. There's going to be, Brad, quite a few companies like that.
Interesting. Jim, thanks so much for taking the time.
Thank you so much. Appreciate the time.
Thank you.
We continue our coverage of the IPO market with SailPoint CEO Mark McCormick live from the Nasdaq on Thursday at 11 a.m. Eastern Time. You do not want to miss it. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. OpenAI CEO Sam Altman turning down an Elon Musk-led buyout offer, saying his company is not for sale. Altman making the comments in an interview with Bloomberg Tuesday, saying Musk is a competitor who is just, quote, just trying to slow us down. The Wall Street Journal reported Monday that a consortium of investors led by Musk is offering the nonprofit $97.4 billion for the company. Altman immediately followed up with the post to X, writing, "No thank you, but we will buy Twitter for $9.74 billion if you want." And of course, their spat has been playing out over social media for a few weeks since the inauguration now, with Elon Musk having his own interests for XAI, and of course Altman wanting to make sure that OpenAI continues to get some of the dollars in VC or company corporate-led dollars that have been promised to it, get those ingested into the business to continue scaling, and at the same time Musk trying to offer a competitive product.
Yeah, exactly. I mean, these are two gentlemen who clearly don't get along. They have their viewpoints on where AI is headed and how it should be approached, obviously coming from two very, very different perspectives. That has very much been on display with some of the commentary that we have been getting here over the last 12 to 24 hours from both involved. So again, when you take into account what this ultimately means, obviously Altman has expressed some of the concerns about some of the rapid advancement that we've seen of AI, and it has very much talked about the fact that it is progressing at least faster than Moore's Law in his view, predicting that AI is coming into artificial and general intelligence is coming into view. Then you have Musk, who's being a little bit more vocal and a little bit more of a, I guess, put it in Sam Altman's words, he called him clearly a bully in the past year when it comes to some of that commentary surrounding AI. What I also thought was interesting is just what Altman had to say about DeepSeek, and he was complimenting the fact that he said that it does do nice work with the AI chatbot, but he was also very much confident in terms of OpenAI and the direction of that company, the ability that they have, their technological advances in order to fend off and maybe thwart some of that international competition. We know that that has very much been a view and a focal point here of so many investors as of late.
Yeah, Musk, absolutely a boisterous billionaire who does have some bullying tendencies that we've seen play out. A trending ticker that we're watching today as well, Shopify, the e-commerce company, issuing a disappointing first quarter outlook despite better than expected fourth quarter results. Revenue increased 31% year over year in the fourth quarter, boosted by strong spending during the holiday season. There you're taking a look at shares down right now by about 1%. But this did certainly seem like a year or holiday season that we've moved through where some of the e-commerce spending that was projected going into it, by and large, met expectations and on many different stretches of the imagination, as we had seen even NRF, Adobe Analytics, all of them coming out of the holiday season and saying digital and e-commerce was strong. Shopify, one of the major beneficiaries there.
Yeah, certainly. I think when you take a look at the stock, the performance that we've seen in Shopify, remember this is a stock that's risen about 130% off the lows that we saw back in August. So very much priced to perfection. We've seen this time and time again this earnings season and really over the last couple of earnings seasons that if companies don't meet expectations, beat expectations and beat them by a wide margin, also signal strong growth. A lot of the emphasis has been on guidance. We have seen this type of reaction in shares very much so a number of times over the last several quarters. So again, Shopify under a bit of pressure here this morning. They did fall short on some of those metrics. Revenue coming in slightly better, but when you take a look inside some of those revenue trends, monthly recurring revenue, that actually fell just short of the street's expectations at $178 million.
People might be trying to save some money. Maybe not do as much online shopping.
It could be, yeah, and for good reason, given some of those macro pressures. All right, well, that does it for Morning Brief. Keep it right here. Catalyst coming up next. Welcome to Catalyst. Some breaking news at the top of the hour. The text of Fed Chair Jerome Powell's opening remarks to Congress crossing the wires right now. Let's head to Yahoo Finance's Jennifer Schomburger. She's inside the Beltway with the latest. Jen.
Good morning. Fed Chair Jay Powell just sat down about 5 minutes ago to testify before the Senate Banking Committee in the first day of his two-day semi-annual testimony to Congress, where he will tell lawmakers that the Fed is not in a hurry to adjust interest rates. Powell will say, quote, "With our policy stance now significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance." Powell stressed that if the economy remains strong and inflation shows little progress towards the Fed's 2% goal, then the central bank could maintain rates steady for longer. If, however, the job market were to weaken unexpectedly or inflation were to fall more quickly, then the Fed could adjust rates accordingly. Powell will say, quote, "We will do everything we can to achieve the two goals Congress set for monetary policy, maximum employment and stable prices." Powell's reiteration that the Fed is not in a hurry, rather, to hold rates steady comes in the face of uncertainty about the impact of the Trump administration's policies and stubborn inflation. Chairman Tim Scott, who has just started this hearing behind me, is expected to press the Chair Powell on the reproposal of Basel III and streamlining regulations for banks. Meanwhile, the ranking member on this committee, Senator Elizabeth Warren, sent a letter to Powell last night saying, quote, "Why is the Fed planning to weaken banking rules pending the stress tests?" Back in December, the Fed said it is looking for comment on creating more transparency for the bank stress tests. Guys, this hearing getting underway just now.
All right, Jen, thanks so much. Let's get a deeper dive on what we could expect to hear from Fed Chair Jerome Powell's testimony. We want to bring in Thomas Simons joining us here at the desk, Chief U.S. Economist at Jefferies. And Thomas, it's great to talk to you again. So some of the commentary that Jen was just walking through, of course, a lot of the focus from the street is going to be on inflation, some of those inflationary pressures that maybe we could see here in the coming weeks. I'm curious whether or not you agree with the sentiment that those inflationary pressures are well anchored at this point.
So that's a very good question. I mean, I think we saw some fairly disturbing data from the University of Michigan on Friday, and I was taking a look at sort of like where the sources of all these concerns about inflation expectations rising come from, and it really sort of rests along the political divide. Republicans think inflation will literally be zero in the next year, and Democrats, it's like 4.5% or 5%, something like that. The middle is kind of bouncing around. That looks to me like it is getting to the point where it's arguably unanchored. It's at least like sort of a subsection of the population has become very unanchored, right? And that does influence behavior and economic decisions and whatnot. So it could be an issue that they need to keep an eye on, but there's not a whole lot they can really do about it at this point.
How does that data that you mentioned set up Powell heading into his remarks today as he tries to paint a narrative of success from the Fed in front of the Senate, given that he just had this challenging data backdrop? Is that going to make things more challenging for him?
No, I mean, I think that he's actually done pretty well to sort of set this up in some of his recent comments. Back when the Fed really accelerated their pace of hikes back in June of 2022, I think it was, he cited long-term inflation expectations in the University of Michigan survey as one of the things that said, all right, we got to go 75 basis points a meeting. Since that time, he's specifically sort of dropped the reference to that particular survey, and now it's like, all right, well, some expectations are rising, but data from the Conference Board and their consumer confidence survey, that doesn't quite show the same type of thing. There's still stability in market-based measures like TIPS break-evens and things like that. They've drifted higher a little bit, but I don't think that they're in the zone that's really particularly concerning that policy is, sort of misappropriated.
What do you think the policy path should look like going forward, given what we know? Obviously, there's so many unknowns out there, but just Powell's comments, he's not in a rush. That very much seems to be consensus at this point. I guess we talk about the tipping point, right, or what they need to see in order to feel comfortable to potentially cut again. What does that look like? So
I think they do need inflation to be broadly much closer to 2%. They are going to get some help, I think, with that in the next couple of months. Early last year is when we had a lot of the inflation sort of pressure that was surprising to the upside. They probably need to see some labor market data weaken a little bit to give them really the strongest motivation to cut, more than maybe one more time. But the initial way you answered or asked the question was like, what should they do, right? I think
it's hard.
It's a little bit of a loaded question, but I think that they really need to get away from this concept that there's an individual neutral Fed funds rate and that the gap is really particularly meaningful because, I don't know, we can talk all afternoon about this, but like there's a number of different things that we've seen or we didn't see that we expected in the tightening. I think that's because of a lack of sensitivity there, and thus the framework might not be as useful as it once was.
That's really interesting because it makes me wonder how much power he has in his ability to shift the market with the things that he says in front of the Senate. For example, today, is it enough to kind of spook the market into thinking he may not cut, or does he have to spook people enough to think he might hike?
Yeah.
How do you think about that relationship?
I think, there definitely is a game going on right now where it's all about managing expectations rather than needing to adjust rates one direction or the other, right? Like 50 basis points plus or minus here or there is not going to, throw sand in the gears of the economy. As a consequence, they cut 100 basis points. I think that they have characterized that ex post as like some sort of insurance policy. Now it's guidance that something else could happen as sort of like their next insurance policy that is actually a little bit cheaper because it doesn't require a whole lot of action. So it's a difficult path to go down, but also I think there is some comfort in the fact that policy right now, since it isn't having, at least in my view, such a strong impact on actual things going on in the economy right now, it means that the risk of being wrong with policy is actually somewhat lessened, right?
What's your assessment of the U.S. economy?
I think it's in the aggregate in very good shape, right? I think that the economy is more sort of heterogeneous than it has been in probably decades in terms of like some sectors doing better than others. Manufacturing outside of AI and electricity infrastructure investment is quite weak. There's individual big manufacturers that have problems with some of their products that fly in the sky. And the housing sector is a mess too. But consumer demand still looks pretty good. I think that a lot of the concern about the aggregate credit numbers is a little bit overblown. And again, obviously, just because you look at the amount of, say, credit card debt that's out there on any, over time, right? It is an up and to the right chart, right? It actually flattened fairly significantly during the pandemic when a bunch of people were able to pay off their credit cards. There's another metric that I look at from the Philadelphia Fed that shows the percentage of people who pay off their balance every month. That at a level shift in 2021 or 2022, one of the big stimulus check payments, that went from 36% to 38%, right? And you can, I think, on one hand, look at that and say, like, that's almost nothing, right? But it didn't go back down, right? And I think that that's actually a sign of, like, really healthy balance sheet for households. Being able to pay off credit card debt and not continually pay interest is like the first step towards anybody actually getting out from under debt and then, having wealth creation be possible, right? So that and the fact that the economy hasn't actually slowed alongside most of these deteriorating credit metrics, we could see many years from now with revised data, maybe it doesn't look quite as good. But from where I sit right now with what I see, I'm not as worried about it.
And given that kind of resilient picture you paint towards monetary policy, is the same true when it comes to fiscal policy and what we might see when it comes to tariffs?
Yeah, well, I mean, this is a really difficult question because the way that the administration talks about tariffs and their relation to revenue generation, revenue collection is frankly just not realistic, right? And also the policy has been very inconsistently applied even in the last 3 weeks of the first 3 weeks of the administration. So I don't think that it's something they can really factor into their models as sort of like what they're expecting revenue to be and thus how much they can increase spending. I think we're like a long way away from having settlement on this fiscal issue. Even just now looking at headlines about this sort of like right hand not talking to the left within the Republican Party in Congress, the House going one way and the Senate going with another approach. It just seems to me that it's going to get messy before it gets better.
Thomas, how much focus are you still placing? Are you placing much emphasis on the labor market at all at this point?
Well, I mean, I'm carefully watching it to make sure it doesn't deteriorate. Right. I don't think that there's some sort of like crack forming or some shoe to drop necessarily. Every time I've expected that something like initial jobless claims are going to go up, they either go up less than I thought or they stay quite low. So layoff activity is still pretty sluggish, and so long as that's the case, I think that means that there's some good stability in the labor market, even if it is more difficult to get a job if you're entering the labor market now.
Forgive me for asking this, but the wage growth number from Friday, is there any chance that there's too much growth happening right now? Is that a potential risk that we're not talking about enough?
I don't think we're quite there yet. I think you could actually make some arguments that was a little bit of a technical quirk, like the work week fell a little bit, right? I always think that data is funny because we obsess over these like 0.1, 0.2s. It's really like 6 minutes of work over the course of a whole week, right? And anyways, it does tend to amplify some increases in the average hourly earnings number. So like if the work week were steady, it probably would have been somewhere closer to 0.3%. And when you consider that January is typically a month when a lot of labor contracts are renegotiated and a lot of prices change,
seasonal.
Something we'll see in the CPI data tomorrow, I'm sure. To me, January has a relatively wide range around it where I kind of take signal from that. So I would be very surprised if we saw something like that strong again in February.
All right, really helpful insights as always, Thomas. Thank you so much.
Thank you.
Really appreciate it. You're going to stick with us as well. We're going to continue having all of your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Catalysts.
You're looking at a live shot of the opening remarks at Fed Chair Jerome Powell's semi-annual monetary policy report. Senator Elizabeth Warren speaking right now. Investors very much closely listening to what we're going to be hearing from Fed Chair Jay Powell during that Q&A for any indication of monetary policy plans for the coming months. Our very own Jared Blickery has a look at how the market has responded in the past to some of Powell's commentary during that semi-annual update. Jared.
Thank you, Shauna. Powell has done this 14 times in the past, gone before both the Senate and the House, and he does this twice a year. So going back to 2018, I took all of those days and added them up and tried to find any patterns and consistency here. What I found that is on day one, regardless of whether it's the Senate or the House, and it happens to be the Senate today, there tends to be a little bit of a gap up, and then the market drifts down over the session and closes very, very slightly negative. And this is just the median look, and the average is pretty similar here, but I think it's instructive that we actually gapped down. So we began the day in the red, and we really haven't done much since then. And the negativity, though, on day two seems to reverse. So let me show you what that chart looks like. We have day one still in white, and day two we have in green. And I'll just trace this out to you. You can see we also tend to gap up, and then we got a little bit of a rise here. Into the end of the session, though, there is a flip, and we tend to close in the green here. In fact, that's worth about 15, 16 basis points, which isn't a lot in the long run, but again, we're just dealing with tendencies here. So it doesn't have to play out today, but I think it's instructive that we learn that not only does today not have to match in what happens tomorrow, but we do have a little bit of a negative bias today, which rolls off for tomorrow. Guys?
All right, Jared, thanks so much. Appreciate it. We also want to go back to that live shot now from the hearing room where Fed Chair Jay Powell is set to testify in a couple minutes. You can actually see Jay Powell on screen, so we'll see if we need to get you that commentary soon. Investors are also awaiting the latest read on inflation that is set to come out tomorrow morning here. Still with us, we got Thomas Simons, Jefferies chief U.S. economist. And joining us now, we also have Yahoo Finance's own Alexandra Canal for the conversation. Thomas, I want to start back with you here because it's interesting. We saw, obviously, Powell this morning not saying much, which is typical of his remarks, leaving himself open to optionality, seeing a little bit of a lack of movement in the dollar, stopping some of the selling off that we might have been seeing earlier today and in treasuries as well. From your point of view, is anything he says today going to move the needle?
So I think there could be, but it's not going to be, I think, the commentary that's really directed towards interest rates, right? So, you know, as much as we live in a very fast news cycle time, and I think we think that there's a lot of information that's come out since the last time he spoke after the FOMC meeting, like really very little has changed. There's been very little data that's really changed much. There's been very few certainties about policy and the impacts there. So I do think that and I think that Elizabeth Warren may have hinted at this before, but the Basel III, bank regulations, that's a topic that we talk about a lot in the Treasury trading room at Jefferies is the potential that lowering the SLR ratio or some other rules that allow banks to carry more treasuries on their balance sheets at a lower capital costs could potentially improve a lot about the Treasury market liquidity. Could have a big impact on swap spreads as they become more attractive. So that would be, I think, probably the most likely kind of delta in sort of market reaction, but I doubt that his comments on monetary policy are really going to move the needle too much.
Yeah, certainly. And Ali, I know you've been tracking just a real-time look that we've seen in the dollar, the strength of the dollar. Obviously, it's been a focal point here for so many companies during this earnings season. How are they navigating some of that uncertainty or maybe the headwind that comes with a stronger dollar?
Yeah, and we see a lot of the companies that have been hit with the negative foreign exchange headwinds. It's been companies with a lot of exposure overseas, and that ranges from everything from big tech to consumer-facing companies. We just heard from McDonald's. They weighed in saying that they expect foreign exchange to continue to be a headwind. Amazon issued disappointing first quarter guidance, and a lot of that had to do with foreign exchange. Apple says it continues to expect a negative FX impact going forward. So it's something to continue to watch. The U.S. dollar did hit its highest level in more than 2 years last month on the back of Trump's inauguration. We've seen this acceleration to the upside as we have this recalibration of Fed easing in the face of this strong economic data that we've been receiving. Tomorrow's CPI print is going to be another one to closely watch. Any impact on the dollar there as well. But we saw the jobs report come in especially strong too. So it's something that Morgan Stanley and a lot of other analysts, Mike Wilson, he had a note out ahead of earnings season saying that he expects this phenomenon to continue. And to that point, Goldman had a new note out saying that over the past few months with these earnings calls that have trickled in, the mentions of foreign exchange headwinds in those currencies has been on the uptick. So I think this is going to continue to be a narrative in the quarters to come, and we've already seen the impact in these results.
Well, it's interesting because I was looking at some data this morning too that you're mentioning here that about 28% of company earnings, when you look at all 500 companies in the S&P, come from other countries.
Right.
And all of that stands to be impacted potentially by the dollar. So Thomas, I want to bring you back into this conversation. If we do continue to see that strength in the dollar, could that potentially then have a negative impact on the economy by hurting consumers and therefore then hurting markets, and it all comes together?
Absolutely. I mean, there are always trade-offs, right? Like if you have a stronger dollar, something like commodities end up being a little bit cheaper. They're a little bit easier to purchase, like oil or what have you. However, it does have a big impact on all these consumer products, and it's kind of, orthogonal with the Trump administration's goals of rebuilding the manufacturing base and all these things. You're literally doing that into a less competitive market for those products globally. So I don't really have a strong view of the dollar continuing to strengthen much more from here. I do think that the Fed is going to end up being more restrictive than the ECB and its other global counterparts. So that interest rate differential will probably continue to be a thing that supports the dollar, on top of tariffs as well. So absolutely, this is a story that is just really getting going, and it'll be interesting to see where it goes for sure.
All right, Thomas Simons, we really appreciate you taking the time. Thanks so much for joining us here at the desk. And of course, our thanks to Alexandra Canal as well. Want to head live to Federal Reserve Chair Jerome Powell's testimony before the Senate Committee on Banking, Housing, and Urban Affairs. Let's listen in.
Commitment to having a conversation with all of us about how you do that well. You and I had a conversation yesterday. Some of it was frustrating, some of it was illuminating. But in the end, my goal is to make sure that the American people, and specifically those working paycheck to paycheck, have more opportunities to succeed, not fewer. You have said that the Fed is not against innovation, and banks are perfectly able to serve crypto customers as long as they understand and can manage the risks. Yet you have admitted that the threshold has been a little higher for banks engaging in crypto activities. Last week, I held a hearing on debanking and once again heard that federal banking agencies, in particular the Fed, use reputational risk as a tool to encourage the debanking of certain legal industries and law-abiding citizens for political reasons not tied to safety and soundness. Debanking is a top priority for this committee, and it certainly is for me, and one that I believe is a bipartisan issue. Will you commit to working with this committee to end debanking, including working with the new Vice Chair of Supervision, once appointed, to revise the Federal Reserve supervision manuals to remove reputational risk as a tool to weigh in on political topics?
I'm happy to make that commitment.
Thank you, sir. Accountability is very important. I would like to think accountability is a priority for everyone, especially the Fed, given that failures in Fed supervision can result in the loss of billions of dollars. Yet following the failure of the Silicon Valley Bank, which was in part due to the failures of its regulators to identify egregious mismanagement of interest rate and liquidity risks, we have yet to see any regulators be held accountable. And as you recall, that was a point of my frustration. As a guy who's spent a lot of time in the private sector, 15 years running a few businesses, I can tell you that accountability is a necessary part of making the entire organization healthier and perform its job as well as possible. I'm encouraged that the FDIC has begun the process of holding SVB executives accountable. That's good news. But no Fed employee has been fired, put on probation, put on performance improvement plan, all of which would be expected in the private sector, as I just mentioned, for employee failure. Please explain to me why Fed employees are held to a different standard from my perspective than everyone else, and what are you planning to do to take accountability for Fed failures in supervision?
So we've actually done quite a lot in response to the events associated with Silicon Valley Bank. So we've done many, many things. In terms of specific accountability, what we found was this was not a case of malfeasance or nonfeasance so much. It was a case of people were carrying out a specific playbook that failed to cause us to act in time for these things. So it wasn't actually particularly fair to the employees to say you violated our practices in some way. That wasn't really what happened. What happened was, I would say, a lot of focus on process and on governance and controls, and not enough focus on basic bread and butter banking, credit risk, liquidity risk, interest rate risk, things like that. So as we discussed yesterday, we took very substantial steps to avoid further spread of those issues, and that was successful. But I understand your point on accountability.
This is one of the areas where you see the approach of looking at safety and soundness, and with the number of MRAs and MRAs that when really documented but no action was taken, that leads me to the conclusion that individual employees, supervisors, should have been held account for that. I'll move on, though. In the past, you've supported tailoring regulations so that we ensure banks of different sizes thrive and to preserve our diverse banking system. Will you commit to working with me as chairman to make sure that financial regulations do not impose more burden than is necessary? I'll say that this comes after a number of conversations with community banks and regional banks that have continued to stress that the cost of the regulatory framework around them isn't just harsh, it's oppressive. Larger banks suggest that the cost per employee for the regulatory framework is $10,000 per employee. I think we can do better, and would love to hear your thoughts on that.
Right, first of all, I will commit to working with you on that. We do try to avoid excessive burden. I think it's fair to take a fresh look on, frankly, on debanking. I think we all see, both in your hearing and in the one on the House side, we hear a lot of people talking about that. And, it's time to take a fresh look, I think. We don't intentionally do these things, but sometimes regulation leads things to happen, and we need to be working on that.
I appreciate that, and I'll turn it over to the ranking member. I'll say this, after having a number of conversations with CEOs of banks around the country, one of the things that was made clear to me with specific statement from these CEOs is that the regulatory OCC and other regulatory agencies said specifically to debank certain industries, and that is the point that I'm making, and one that I think we have to solve. If it's legal in America to do business, we should do our part to make sure that they're banked.
Thank you, Mr. Chairman. So over the weekend, Co-President Musk and Acting Director Vogt effectively shut down the CFPB. No more cop on the beat looking out for a family of four in South Carolina facing an illegal foreclosure. No more cop on the beat looking out for your grandma whose bank account has just been taken over by a scammer. No more cop on the beat looking out for people getting ripped off by giant credit card companies that are charging illegal junk fees. It also means that the CFPB is no longer doing one of its most important jobs, examining big banks to root out illegal conduct before it happens, or at least stop it before more people get hurt. Chair Powell, if the CFPB isn't on the job right now, then who is administering JP Morgan or Wells Fargo's consumer compliance exams to ensure that they are following the law?
Senator, I believe that, and you would know, that Dodd-Frank moved all authority for examinations in the consumer space to the CFPB. We still have some jurisdiction.
We'll talk about that in a sec. But the answer to my question, please. If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
No one, in other words. So thanks to Co-President Musk and CFPB Acting Director Vogt, Wall Street banks no longer have to show the bank examiners that they're not illegally opening accounts people didn't ask for, like happened with Wells Fargo, or charging illegal junk fees like the Bank of America did. But CFPB has jurisdiction only on banks that have more than $10 billion in assets. So what's happening in thousands of community banks all around the country, those that have less than $10 billion in assets? So Chair Powell, as you know, the Fed oversees consumer compliance for state member banks that have less than $10 billion in assets. Has the Fed suspended consumer compliance exams for those smaller banks, or is the Fed still on the job to make sure that those smaller banks are following consumer financial laws?
Still on the job, business as usual.
All right. By forcing the CFPB not to do its job, President Trump, Elon Musk, and the author of Project 2025, Russ Vought, are giving Wall Street banks an unlimited get-out-of-jail-free card so they can cheat working families, even by forcing the CFPB not to do its job. President Trump, Elon Musk, and the author of Project 2025, Russ Vought, are giving Wall Street banks an unlimited get-out-of-jail-free card so they can cheat working families, even while community banks continue to play by the rules. You know, for any Americans who have money deposited at JP Morgan or Wells Fargo or any other of the giant banks, they should now know that there is no one on the job to make sure that those banks are not scamming you. Only the smaller banks now have a cop on the beat to make sure that they aren't cheating consumers. You know, if I have my money in one of those giant banks, I might think about going to a smaller bank where the protection, at least right now, is a whole lot better. Now, at the same time that the CFPB is under attack, the Fed is buckling to pressure from Wall Street to erase other safeguards for the too big to fail banks. During the first Trump administration, under your leadership, the Fed weakened the big bank stress tests, including by giving the big banks some of the answers to the test in advance. I called you out on it, but you promised right here in this committee that you would not give those banks the whole answer key. I'm going to quote you back. You said, complete knowledge of the models could lead to a model monoculture in which all firms have similar internal stress testing models, which could increase the correlation of risk in the system and miss key idiosyncratic risks faced by the firms. I agreed with you. But several weeks ago, the Fed announced that it has plans to do exactly that. Hand all of the answers over to the giant banks. Chair Powell, why is the Fed about to propose a rule that directly contradicts your own testimony and, in your own words, would render the stress tests toothless?
Senator, in essence, because the ground has shifted very substantially in administrative law, and we actually want the stress test to remain resilient to that. And so we're making changes to accomplish that.
Well, the changes are changes you've identified earlier as making those tests toothless. Look, the big banks are going to juice shareholder payouts and leave this economy more vulnerable to a crash. The Fed is knuckling under to bank lobbyists. We know how this ends. People will suffer. Wall Street will get bailed out. I urge you, Chair Powell, to serve Main Street instead of Wall Street. Don't weaken these rules.
Thank you. Senator Rounds.
Thank you, Mr. Chairman. And Mr. Chairman, thank you for coming before the committee. I appreciate the opportunity to visit with you. I've got a series of questions, but I would like to give you an opportunity, if you would like. The suggestion that the ranking member has made here is that the big banks can now scam individuals right now. Any change in the laws regarding how they're supposed to be treating the individual consumers out there or anything along that line?
Law changes? No, I'm not aware of any.
Any changes, any rules that they would have to follow?
Not that I'm aware of.
Are they still audited, and do they still have the regulators in watching all of their businesses just as they did before?
Well, they'd have all the regulators except for the CFPB.
Very good.
If in fact, in the hypothetical, the CFPB weren't carrying that out.
Anything else you'd like to add before we move on?
No, I'm good. Thank you.
Thank you, Mr. Chairman. As we continue to prioritize the stability and the resilience of our financial system, the ongoing Basel III rulemaking process has remained front and center in shaping our regulatory framework. I guess I was rather outspoken with my opposition to the original proposal, and further work was stalled at the end of the last year. I guess my question for you today, sir, is could you provide an update on the Federal Reserve's progress in finalizing the Basel III endgame rulemaking process?
I'd be glad to. So we remain committed to completing Basel III endgame. We think it's good for U.S. banks. It's good for our economy that there be a global standard beneath which foreign banks can't fall. And that was one of the big ideas behind the whole Basel Committee approach. So where it sits now is we await leadership arriving at the OCC and the FDIC, and that seems to be happening. And when that happens, we're going to sit down with them and work our way through to a Basel III endgame proposal. And I think we can do this reasonably quickly, one that is compliant, consistent with the Basel requirements, and also consistent with what other large jurisdictions are doing. I'm optimistic that we can do that fairly quickly, and we're committed to doing that.
We always wanted our banks to be competitive with European banks. And I'm just curious, the original proposal that was in front of you, and I'd like your thoughts on this, it was estimated to increase our bank's capital by 19%, which I think may very well have created a potential disadvantage within the U.S. institutions versus our European counterparts. With any new proposal, what's your thoughts? Would you make a commitment that this would be a neutral approach with regard to capital?
The main commitment I'll make is we'll work together with new leadership at the other banking agencies to do something. But that's certainly, I've said many times in this committee that I think that the level of capital in the largest banks is about right, and so it'll shake out somewhere in that area. I would
Our
guess,
expectation would be, and the markets would expect that it would be neutral with regard to capital
in that range. But I want to defer to our new colleagues and get their views as well. But that's a good starting place.
Okay, thank you. The Federal Reserve's partnership with the U.S. Treasury plays a central role in supporting our nation's payment infrastructure, which processes a vast range of daily transactions, from federal benefit disbursements to debt obligations. Could you outline the Federal Reserve's role in supporting and managing the Treasury's payment systems, including how the Fed works to keep these systems secure, efficient, and capable of handling the government's high volume of daily transactions?
So it's a complicated set of arrangements, and I'll try to summarize quickly. Effectively, Congress authorized spending, and then the agencies carry out those spending orders. And when the way they do that is they send an order to pay a payee, a recipient, to the Treasury Department. Upstream, before it gets to the Fed, all of these decisions are made about, is this an appropriate order? Is this payee on the don't pay list, and all those things. Once all of that is set, it comes to the Fed, and by that I mean 4 or so of the reserve banks, and we actually make the payment. We take the money out of the Treasury General account and we make the payment. We make no judgments whatsoever. Those are all made upstream from us, and we are in fact the fiscal agent of the Treasury.
Confirm for me today, is the system safe today?
I believe it is, and I will tell you, we are very strongly committed to the integrity, efficacy, resilience, and all those things of this system. And people do depend on this in a big way, and we're committed to that.
One last question for you, sir. The failure of Silicon Valley Bank, and the chairman brought this up. I'm just curious, recognizing a lot of banks out there looked at this, it cost the other banks in the system a lot of money to pick up the costs involved in the losses. Nobody's been fired. But you did indicate that it was a failure in the playbook. Has the playbook been revised, or can we expect that it will be revised?
In a lot of ways, it's been revised, yes. I can go into some details. I mean, one thing that didn't happen was, for example, the supervisors didn't follow through aggressively enough on things that they'd said. If they'd done that could well have been enough to stop it. Yeah, but a lot of it was just not focusing enough directly on what was a very large amount of interest rate risk, a large portfolio of long-term securities matched up with an unstable funding base. And somehow people wrote about that, and not the Fed, but others wrote publicly about this, but somehow we don't expect bank runs outside of a crisis in this country, and that's what that was. It was a bank run, and bank runs are incredibly damaging. I think everyone learned a lot from that and is determined to do better.
Thank you, Mr. Chairman. I think this is one that I think, as you appropriately pointed out, I think this is an area where a lot more questions are out there yet, and I think if it's the playbook that was the problem, I think perhaps a discussion about how that playbook has been revised would be appropriate in the future. Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto.
Chairman Powell, thank you. And thank you always for the conversations in between these hearings as well. Let me focus on a couple of things of concern. And you touched on a little bit of this, and I think this is important to clarify. There was a change in the law when the CFPB was created. The CFPB examines the banks and enforces the law, whereas the Fed only supervises those banks. Is that correct? Or how would you determine that relationship?
With the CFPB? So Dodd-Frank took a lot of the consumer compliance jurisdiction away from the other banking agencies and gave it to a newly created agency, the CFPB. We retained a residual amount of that, as we just discussed, which was banks under 10 billion in assets. But the CFPB essentially took all of that when Dodd-Frank came into being.
So as it was created, when you two were working together, the Federal Reserve collaborated with the Consumer Bureau when supervising those large banks, correct?
Yes, we still retain supervision over all the holding companies and also of Fed member banks.
And let me ask you this then, does the Federal Reserve enforce consumer protection laws now for things like money transmitters?
Not for money.
That would be the consumer protection. That would be CFPB.
Yes, yes.
Okay.
That's
And
right.
so when we're talking about collaborating with the CFPB for financial technology firms, what would the Fed Reserve now do that if the CFPB, if the hypothetical is the CFPB no longer exists, what would be the Fed's role right now with respect to technology firms?
We don't have jurisdiction over, we have jurisdiction over banks and some financial market utilities.
So let me ask you this, because I know there's a number of Nevadans who file consumer reports of concerns about fraud and predators with the CFPB. The Fed Reserve doesn't receive those reports, correct?
No, I don't believe so.
And you have no role when it comes to consumer protection like the CFPB does, correct?
Unless you're a Fed member bank that has 10 billion or less in assets, then we have jurisdiction.
Right.
On a
So there
consumer.
is a gap. If the hypothetical is true, and what we're hearing that the CFPB is being shut down, there is a gap, what we're hearing in enforcement out there, and particularly when it comes to consumer protection. Is that, would you say that's true?
Yes, for all banks that we don't supervise.
And I think that's the concern we're all having right now, is this concern of when we're looking to streamline government. And listen, I'll be the first to tell you, there's a lot of bloat. We need to streamline it. We need to address regulations and overreach. But there's a strategic way to do it, and not this burn down the house that is going to harm people across the country, including in my state, those Nevadans that are looking for some sort of enforcement around consumer protection law. So that's what you're hearing from many of us on our side of the aisle here.
Can I just very briefly add that we do have some residual enforcement authorities, but what we don't have is examination authority, and for the banks that the CFPB supervises.
Thank you. Let me ask you this, and we talked about this over the phone, and I understand it may be difficult to answer this, but the Federal Reserve Board members have been clear that future interest rate cuts are unlikely to happen despite the strong economy. But there are folks in my home that are in my state that are waiting to buy a home. And we know that's still an issue, the high prices right now for home affordability. You add the interest rates to it, it is a problem. So do you think it's most likely that interest rates will remain above 6% for this year, or can you even address that?
So overall, the economy is strong, growing 2.5% last year. The labor market is also very solid. Unemployment at 4%, quite a low level. Inflation last year was 2.6% for the year. So we're in a pretty good place with this economy. We want to make more progress on inflation, and we think our policy rate is in a good place. And We don't see any reason to be in a hurry to reduce it further. As it relates to housing, so it's true that mortgage rates have gone or remained high, but that's not so directly related to the Fed's rate. It's really related more to long-term bond rates, particularly the Treasury, the 10-year Treasury, 30-year Treasury, for example. And those are high for reasons not particularly closely related to Fed policy. They may remain high. I think, once we lower rates and kind of rates return to a lower level, mortgage rates will come down. I don't know when that'll happen. And even when it does happen, we're still going to have a housing shortage in many places.
Thank you. Chairman Powell, thank you again for being here.
Thank you, ma'am. Next will be Senator Kennedy.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here.
Okay, great. Yes,
my friend, our ranking member, said that you are knuckling under to the big bank lobbyists. Is that true?
No.
It seems to me that the big picture should not go unnoticed. Do you recall a year or two ago when inflation was raging? I think its peak was about 9%. Many economists and other experts, based in part on history, said that you were going to have to provoke high unemployment and put our country into recession in order to get inflation down. Do you recall that?
Very, very well.
Are we in a recession?
We are not.
Would you, as an American, trade places right now with Germany in terms of the economy?
No, I sure wouldn't.
How about China?
No, wouldn't trade places.
How about France?
No, thanks.
Things aren't perfect. Inflation's obviously still sticky, and long rates are too high, which I want to talk about in a second. But the fact is, knock on wood, we have experienced a soft landing, haven't we?
Not for me to say, really. I'll let others.
Well, have
make
we
that.
experienced a hard landing?
No, we sure
Are
haven't.
we in a recession?
No, we're not.
I call that a soft landing. And it seems to me that you and some of the ladies and gentlemen who are your colleagues at the Federal Reserve behind you deserve some credit for that.
Thank you.
I don't know why you don't take the credit. Everybody else in Washington, D.C. does. Again, I'm not saying things are perfect, but I never imagined that our landing could be this soft, albeit not perfect. And I wanted to thank you and your colleagues for that effort. You sure didn't get any help from Congress and on the our president on the fiscal side. I don't expect you to comment on that. You and the Federal Reserve can to a large extent control short rates, can't you?
Yes.
Through the Open Market Committee. You can't control long rates, though, can you?
No, we can't.
Why is that?
So a lot of things go into long rates, and one of them is the expected future short rate of Fed policy, but many, many other things go in. Expectations of inflation in the longer run, the sort of risks around the economy and around the budget deficit go into something called the term premium, which is the part we can't explain when we do these decompositions. And so, it's set by supply and demand in the bond market at the long end, and we're not particularly. We have some influence, but mostly not.
Many Americans are looking at short rates and looking at the Fed's behavior and how you reduce inflation, but they don't see the long rates going down, and obviously that affects mortgage rates. And I would encourage you and your colleagues to spend some time explaining to the American people why that is. Final question. If you went home tonight and Mayor Powell, your spouse, said, I got a call today from our bank, and they're debanking us. They're worried about their reputational risk because they don't like our politics. Would you think that fair?
No, I sure wouldn't. And as I mentioned earlier, I too am troubled by the quantity of these reports, and really want to understand better why this is happening. One theory is that banks are just very risk averse around BSA and money laundering, and that's because we're so tough on them, and that they just don't. Any red flag is enough. But it may be that this whole thing with reputation risk needs to be thought about. It's actually coming out of our one manual that we use. We're taking that concept out of the manual that we've been using for account access for master accounts. We're just going to take that out. But I think this needs a fresh look, and I think it's time for that, and we're going to do that.
Well, I've asked our chairman, and he has agreed to invite some of the CEOs of some of the banks that have been debanking people. The CEOs,
Yes.
Not their lawyers, not their PR consultants,
Not the lobbyists.
not their priests, them, the CEOs to come in and let's talk about this and find out what the hell's been going on.
Thank you, Senator Kennedy.
Thank you, Mr. Chairman.
Senator Reid.
Thank you, Chairman Scott. Chairman Powell, welcome. Thank you very much. I think your monetary policy combined with the Biden fiscal policy over the last 4 years has made a tremendous difference. We've avoided a recession. And I'd like to remind people how far we've come. In 2020, the gross domestic product decreased 2.2%. The unemployment rate finished the year at 6.7%. By 2024, gross domestic product grew 2.5%. The unemployment rate was 4.1%. Labor force participation rate went up from 61% to 62.5%. And that's a combination of your work together with the fiscal policy of the Biden administration. So I thank you for that. One of the issues before us today is the issue of tariffs. In July 2018 testimony, you stated, Mr. Chairman, countries that have remained open to trade, that have not erected barriers, including tariffs, have grown faster and had higher incomes. Do you still believe that?
Yes, I do. I would stand by that.
So President Trump's tariffs on China, Canada, and Mexico will obviously raise costs on families. In fact, some economists, many economists, project about $1,200 per year households will be paying extra. An increase of inflation by nearly 1%, economic growth depression, and, for example, the increase of the average car price by $2,700. Is that a wise policy?
So I guess I ought to say this. I think the standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Just this weekend, the president removed the board of the Kennedy Center and made himself chairman. What would you do if the president tried to remove a member of the Federal Reserve Board?
Well, it's pretty clearly not allowed under the law.
Thank you. we've communicated back and forth about synthetic risk transfer as a potential danger to the banking system. And could you give us some insights on how we can improve financial stability by regulating these transactions more appropriately?
So what we've been doing for some time now is looking at them on a case-by-case basis. And if they really do transfer risk successfully, then that's okay. I mean, it's a good thing if a bank wants to transfer risk off its balance sheet in a way that it gets compensated for and all that. But what you want to make sure is that the risk is really transferred, and that was the problem during the global financial crisis, was sort of things that appeared to but did not accomplish a transfer of risk. So we see this coming, and we've been looking at these transactions on an ongoing basis.
Well, I commend you for that. In fact, what happens typically is the transaction becomes complicated by synthetic risk transfers, as it was the case with synthetic derivatives. So thank you for your attention to that. We've talked about housing. It's absolutely critical everywhere across the country. We're in a housing shortage. Of course, while housing is difficult, two of the mainstays of our housing market are Fannie Mae and Freddie Mac, helping to support home ownership. Does the federal guarantee backing Fannie and Freddie help make mortgage rates more affordable and home ownership more accessible, Mr. Chairman?
I imagine it does hold down mortgage rates, the fact that they're a sovereign risk.
And how important is the 30-year mortgage to ensure that families can afford a home?
In our housing market, the 30-year mortgage is very important.
Yeah. And I have heard some discussions about eliminating Fannie Mae and Freddie Mac, which would be detrimental, I presume, to the housing market.
That's really a question for you. I mean, putting them back in the private, putting housing finance back in the private sector has some appeal over the longer run, but I leave that with you.
Thank you, Mr. Chairman, very much. Appreciate it.
Thank you, Senator Ricketts.
Well, thank you, Mr. Chairman and Ranking Member, for holding this important hearing, and thank you, Chairman Powell, for being here today to talk about our economy and all the things that are going on. I want to address, again, something that the Ranking Member started talking off about, which was characterizing the CFPB as being the cop on the beat here. But I can tell you, as having been a governor and having a Department of Banking that reported to me, that if any consumer would contact us and make a complaint about a bank, even a big bank like JP Morgan, we would investigate, as could the OCC, the FDIC, the FTC. So to characterize that nobody's out there looking for consumers, I think, is inaccurate. And we ought not to try and scare consumers right now that somehow this is the case, because if you do have an issue, if you're a consumer, please reach out to your State Department of Banking, because those folks are going to look out for you. I can tell you that because I used to have one of those Department of Bankings. They did a fantastic job of looking out for the consumers. One of the things that has also impacted consumers is inflation. Prices under the Biden inflation were up 20%. An average household is paying $13,000 more today than they were for the same standard of living they had before Joe Biden got elected. We see that grocery prices, for example, are up 22%, rents up 23%. Simply put, Nebraskans are economically worse off today than they were 4 years ago, and I expect that that's part of the reason why we saw this change in the administration. They thought that that was not something that they wanted to continue to pursue. They didn't want the same policies being followed. We have to end the reckless federal spending, rein in inflation, and be responsible about how we make decisions to be able to grow the economy. One of those areas that I'm concerned about is the expansion of the Fed balance sheet. The Fed's balance sheet before, at the end of 2019, so before the pandemic, was about $4.1 trillion. By May of 2020, the Fed expanded that to $7 trillion, and by 2022, the Fed's balance sheet hit an all-time record $8.9 trillion. Inflation peaked at 9.1% that year, a high we had not seen since 1981. Now, I'm encouraged by the actions the Fed has taken with quantitative tightening to shrink the balance sheet down to $6.85 trillion, but $6.85 trillion is still too high. And one of my concerns with the chairman is that that's kind of one of your tools to be able to guard against a downturn in the economy or some sort of shock. You obviously used it during the pandemic. Looking ahead long term, will the Fed Reserve continue to this course of unwinding the balance sheet?
Yes, so what we said is that we intend to slow and then stop the decline when reserve balances are somewhat above the level that we judge consistent with quote so-called ample reserves. The most recent data and the feel of the markets is definitely that reserves are still abundant. They're about the level they were at when runoff started, because the runoff has really happened out of the overnight repo facility, reverse repo. So yes, it's an ongoing thing, and we're not yet where we're headed.
So what kind of pace can we expect? And I know that obviously there's going to be a lot of factors like what happens to the economy over the course of next year. But if things were going to go along the way they are today, you've already said the economy's doing well. Inflation's a little higher than we want it to be at 2.6%, but unemployment's at 4%. If these commissions, and I think you used the word stable quite a bit, if these conditions were to remain stable throughout the course of the year, would you have a range that you could give us of where the balance sheet might be if we were talking again here in January 2026?
We basically we're going to be looking at reserve conditions in reserve markets, and trying to stop a little bit above what we consider ample. And we think we're meaningfully above that now. We can't put a number on it because you can't directly know the demand for reserves other than by observing behavior in the market and then putting a little bit of a buffer on it. So I can't give you an exact number, but for now it's ongoing, and we have ways to go.
What kind of conditions would have to happen for you to start going back to quantitative easing?
So go to quantitative easing. That's a tool we tend to use when we're at the effective lower bound and we can't cut interest rates anymore. So nothing like what you're seeing in the current day. It's a different test for stopping quantitative tightening, but we would use QE going forward only in a situation where rates are at zero, and we're a long way from zero now.
So that you think that, again, just generally speaking, then, if things will remain stable, you'll continue to unwind the balance sheet, you'll continue the quantitative tightening. Can't give me a range on this. Is that what I hear you saying?
That's right. That's right.
Okay, great. Well, I encourage you to keep doing that because, again, I think that's important to be able to make sure that you've got powder for the next issue that we may face. So thank you very much, Mr. Chairman. Appreciate you being here.
Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, good to see you. One of the things we've talked about in the past, and I got 2 or 3 issues I'm going to get through fairly quickly, is that that while our regulatory framework should always promote financial innovation, that innovation can't come at the expense of things like anti-money laundering, consumer protection, financial stability. I continue to worry in many of these hearings where we keep seeing this regulatory creep outside the boundaries of traditional financial regulation. I think if we were starting a system from scratch, few of us would design it this way. But it is one of the reasons why I'm looking forward to working with Chair Scott and my colleague, Senator Lummis, on a framework at looking at stablecoins in particular within the regulatory perimeter. I know my friend Bill Hagerty just introduced a bill in this area. I'm looking at trying to make sure we get those guardrails put in place, and how it touches the Fed is something that's terribly important to me. I know you and I have talked in the past about the notional idea of same activity, same regulation in the non-bank sector. If you'd like to wax briefly on this question around stablecoins and how we think about them in the same point of, if they are similar to other activities, should they not have the same regulatory structure?
So we definitely support these efforts to create a regulatory framework around stablecoins. Stablecoins may have a big future with consumers and businesses. We can't know that now, but it is important for the development of stablecoins in a safe and sound manner, and a manner that protects consumers and savers and all, that there be a regulatory framework. So we see these bills, and we're in contact as we were in the last Congress, and trying to add our technical thoughts and how to do this. And we think it's a very constructive exercise.
Well, we do think, you have a lot of expertise in this session, and there are people that are
people come with lots of opinions on everything in crypto, from over the top to the other end of the spectrum, and I'm gonna need to rely on your expertise as well as we try to work through some framework for stable coins. I know there are a lot of earlier questions on CFPB. I think the record is pretty darn good. It's returned $20 billion to consumers. Matter of fact, the last time we had the previous chair here, Chair Rohit, Ms. Chopra, we were talking about $55 million to Virginians. I do have to mention this more for my colleagues. Tim Kaine and I did a teletown hall last night. Lots of things happening in Virginia. Normally we would get maybe 3,000, 5,000, 6,000 folks on a teletown hall. We had 60,000 last night. I have not seen anything like that in my time up on here on the Hill, and a huge amount of concern about what the DOGE boys are doing, whether our information is safe, whether privacy is protected. I had one lady say, in light of what was happening at CFPB, and while there's not a direct connection, she's saying is her deposits at her bank safe? We tried to give her a assurance, but I said, you know what, ma'am, I'm going to be talking to the chairman of the Federal Reserve tomorrow. And with this diminution or shuttering, at least at the time being, of the CFPB, can I tell, I believe her name was Mary, can I tell Mary from Virginia that her bank account is safe?
I think bank accounts overall across the economy are safe. Yes, we've still got deposit insurance at the FDIC, and the banking system is well capitalized and safe.
Well, again, I think the concern was being raised was that the diminution of consumer protections lent her concerns about whether that dollar being safe. Last thing I want to recognize is that there's been reports in the media about the thinness in the treasury markets, the number of additional bonding that we're going to have to do, particularly with so many of these unpaid tax cuts. Matter of fact, one of the things that was really striking to me was that yesterday the president mentioned how he was, quote, examining treasury debt payments for possible fraud, and suggested that our debt might not be as high as possible. We all understand the full faith and credit of the United States is based upon a reputation. If this president were to suddenly say, I'm wiping off X amount of debt because I don't believe we owe it, what kind of effect would that have on both stability of the dollar and the overstability of our economy?
It will probably not surprise you that I will defer to you on that question.
So you think it would be, from a Fed standpoint, the President of the United States starts to say we're not going to pay our Treasury debt. You're going to have no view at all?
I'm not going to comment on things that the president says.
I would like to see us at some point get a stronger answer on that, because I think that in light of the president's willingness to shut down agencies willy-nilly, his ability to potentially curtail payment of debt, I think would have devastating consequences on our economy. Thank you, Mr. Chairman.
Senator Britt.
Thank you, Mr. Chairman. Obviously, there's been a lot of conversation both in and out of this hearing room today. Conversations about a co-president referencing Elon Musk, referencing the work that DOGE is doing. I think it's important to remember that President Trump ran on this. I mean, he said we're going to look for wasteful spending across our government. We're $36 trillion in debt, y'all. That's not only fiscally irresponsible, it is actually morally irresponsible. And the difference in this administration and the last administration is that President Trump is actually the final arbiter. And it's interesting that none of you had anything to say over the last 4 years when it is clear that our commander-in-chief was not in command. And if we're going to use the term co-president, then let's go back and say co-president Jake Sullivan, co-president Ron Klain, co-president Jill Biden. I mean, it seems that some of the biggest decisions were made during the president's afternoon nap time. And so I just think we need to be a little bit more honest about what's been laid out and what's actually occurring. Chair Powell, I want to discuss some monetary policy issues, but I first want to highlight a few supervisory items. We unfortunately started 2023 with several bank failures in which the Fed itself admits its supervisors were, quote, too slow to ask. The question has been asked earlier about who was fired, who was not. I think that there's some real merit to having accountability that we have not seen there. In the aftermath of those failures, the Fed was certainly not slow to act when it came to new regulations, like the new capital requirements that would have put the U.S. banks at a global disadvantage and actually hurt consumers in my state. The way I look at this is the world came up with a gold standard. And then Vice Chair Barr said, hold my beer. And unfortunately, that hurts Alabamians. In addition to that, we had Community Reinvestment Act and stress testing frameworks that were basically adopted in secret. Or as we discussed last week, the reputational risk and just the arbitrary nature of that and those standards that were used to push political agendas. None of this is acceptable, and we've got to take a look at how to promote greater accountability and transparency into the Fed's supervisory function. Shifting gears, as of January 30th, the Federal Reserve had a mark-to-market loss on its balance sheet of roughly $221 billion. In fact, I looked back and the Fed has posted losses since September of 2022. Meanwhile, we've seen transfers to the CFPB totaling $2 billion since September of 2022. So just to clarify, Chair Powell, these money transfers are requested by the CFPB director each quarter and then directly deposited by the Fed. Is that how that works?
So the director of the CFPB requests money, and we, under the law, we send that money. Yes.
So, in fact, but Dodd-Frank actually prohibits the Fed from actually reviewing or amending those requests.
That is correct.
And so it gives full discretion to the CFPB
up
director.
to I think 12% of our. There's a ceiling on that, but that's correct.
So just to level set, how many times has the CFPB funding request been denied by the Fed?
We don't have the authority
Zero.
to deny it under the law.
Zero, right?
Zero, yeah.
Yeah, that's what I thought. And by the way, I'd like to applaud the current administration and acting director vote for inserting some accountability back into the agency by pausing these quarterly just blank checks. On that, I know there's been a lot of conversation around the Bureau over the last few days, but I do want to focus on those last couple of years, particularly the $2 billion the CFPB received from September 2022 up to the last receipt on January 2nd, 2025. Congress specified in statute that the Fed shall fund the CFPB through the combined earnings of the Federal Reserve System. However, as I mentioned, the Fed has no current earnings. It has a balance sheet of negative $200 billion. So instead of the recent audit statement saying the Fed is funding the CFPB through assessments on its reserve banks, Mr. Chair, there are only two statutes that authorize the Fed to make reserve bank assessments, and neither permit the CFPB to fund transfers. So what authority exactly did the Federal Reserve have to assess the reserve banks in this manner over the last 2 years? I just wanted kind of a fact finding.
We've looked at that question very carefully, and it's very clear on the law and the legislative history that we're still required to make those payments to do so.
Appreciate it. Thank you.
Senator Van Hollen.
Thank you, Mr. Chairman. I would point out that candidate Trump did not run on implementing Project 2025. In fact, when he was asked on the campaign trail about Project 2025, he said, I don't know anything about that. Who are those people? And yet he early on and quickly installed a key architect of Project 2025, Russ Vought, as the head of the Office of Management and Budget, which we know is the command and control center for the budget overseeing all federal agencies. And that's what Elon Musk is doing now. He's implementing Project 2025, the same Project 2025 that candidate Trump said he knew nothing about. And he said that because he knew it was unpopular. He knew it would be unpopular to take the financial cop off the beat. And I want to start by talking about what's happening over at CFPB, the Consumer Financial Protection Bureau, because that is the cop on the beat to go after fraudsters and scammers who cheat Americans out of their hard-earned money. And they have returned billions of dollars to our constituents, to the consumers who have been victims of these scams. And in doing so, they've earned some powerful enemies who want to shut them down. And Elon Musk is doing that dirty work on behalf of those fraudsters. And there's something especially twisted about the richest man in the world shutting down an agency that helps victims of scammers and fraudsters recover just a little bit of their hard-earned money. And I find it especially interesting that the new self-declared head of the CFPB, Russell Vought, told employees not to come into the office and essentially to stop work. Here's what he wrote, and I'm quoting, "Employees should not come into the office," unquote, and stand down from performing any work task, unquote. So this is an interesting situation. Federal employees continue to get paid, but the Trump administration tells them to stop doing their work. That apparently is what the Trump administration thinks is a good deal for the American taxpayer, to pay employees to not to do their job. So, Mr. Chairman, I have a simple question for you. Is that a practice that you pursue at the Fed, to pay your employees but tell them not to come to work? Have you done that?
No.
That wouldn't be very efficient, would it?
No.
No, it wouldn't. And yet, that's what the so-called DOGE boys, efficiency boys, are doing. In addition to that, they're rummaging through the private, very personal, sensitive information of Americans at the Department of Treasury. So it seems to me that the Trump administration and Elon Musk are focused on everything except what Donald Trump said he was going to focus on during the campaign, which was to bring prices down. And when you look at the price of eggs these days, I noticed that Waffle House just instituted a new 50-cent per egg surcharge due to the nationwide rise in the cost of eggs. They said that's going to be a new surcharge, and other restaurants are following suit. You've seen that, right, Mr. Chairman?
Yes.
Yeah. And at the same time, the Trump administration has restricted federal agencies from providing the public with information about the bird flu, avian flu, which is part of the cost of egg increases. So what we're really facing here is an administration that campaigned on bringing down prices and is not doing that, did not campaign on Project 2025, and that's what they're doing. But when it comes to prices, Mr. Chairman, the president's also talking about significant increases in tariffs. Our Republican colleagues are also talking about passing a tax bill that gives way disproportionately to the super wealthy, and which will add trillions to the deficit by their own account. They're talking about playing around with the baseline. So my question to you is simple. All things being equal, do big increases in tariffs and increasing the deficit and debt put upward pressure on inflation? Isn't that simple math?
You know, it really does remain to be seen what tariff policies will be implemented, and I just think it would be unwise to speculate when we really don't know. I mean, we see proposals, but it's so hard to say what's going to happen. And
Well, last time the Trump administration was in office, the Fed took actions because they were concerned about the impact of increasing tariffs. Isn't that the case?
We wound up cutting rates in 2000 and I guess it was 19, right. But it really was because growth slowed and confidence was weak and the global economy was weakening. So the net effect of all that's what we look at. And it's really not just tariffs. It's tariffs, immigration, fiscal policy, and regulatory policy. And those will all go into a mix, and we'll try to make sense of it and do what's right for monetary policy.
If you could just get back to me on the question of increasing the deficit by trillions of dollars and what impact you believe that has on inflation and prices. Thank you, Mr. Chairman.
Yes, sir. Senator Lummis.
Thank you, Mr. Chairman, and thanks, Chairman Powell, for being with us today. I think you're aware of what direction my questions will take. They will be focused on the bank supervision function of the Fed. And I'd point out that when you and I were toddlers, 1956, the chairman of the Fed at the time, William McChesney Martin, said that the Federal Reserve Board is an agency of the Congress. Ben Bernanke said something similar in 2013 when he told Janet Yellen that, quote, Congress is our boss. Do you agree with that statement?
Yes, the way I always say it is that our supervision, our accountability runs through the legislative branch, not through the executive branch, as it does in many other forms of government.
Thank you for that, because I wouldn't have guessed that that was going to be your response. The way that the Fed has behaved for the last 4 years in its relationship with the U.S. Congress is to thumb its nose at Congress. Your staff has repeatedly stymied information requests from this committee, notably made by myself, the chairman, the ranking member, Senator Tillis, former Senator Pat Toomey, and others. In my experience, the Fed is a black hole. It consumes information, but it never releases it. Your fellow governors have personally misled me on at least 2 occasions with respect to Wyoming and digital assets. And in recent federal court filings, former Senator Pat Toomey has accused your staff of lying to him while providing technical assistance on legislation that passed in the National Defense Authorization Act in 2022. Now, I have behind me a statement by the Fed's General Counsel, one of the staff that's sitting behind you today, who said, quote, the Fed generally resists legislative prescriptions. Now, to me, that's thumbing his nose at Congress, the very people that you and I just agreed you are responsible to and the people depend on. So this is why the American people think there's a deep state. This is why they think there are faceless bureaucrats making policy to hurt the very people of this country. Just look at the mess the Fed made of Silicon Valley Bank. And I contend that there is a lack of understanding that is deliberate on the part of the Fed with respect to digital asset policy. So the Constitution says Congress is your boss, but somehow your staff have not gotten that message. So, Chairman Powell, do you commit on behalf of yourself and the Federal Reserve staff to comply fully with all document demands issued by this committee in a timely manner?
Sure.
Will you instruct your staff to be complete in their responses and not to obstruct the oversight functions of this committee?
You know, we always work with the committee to be responsive to your requests. Sometimes they're beyond our capacity to respond to, and we work with committee and with committee staff to do that, but we're always responsive to committee requests.
And I'll look forward to engaging with you when you feel that our requests are outside of the scope of the oversight that we have over the Fed. Do you commit to disciplining or removing any staff that are found to have engaged in debanking activity furthering Operation Choke Point 2.0 or other misconduct?
I can't make an open-ended commitment to remove anybody, but I will tell you that I am struck, and my colleagues and I are struck by the by the growing number of cases of what appears to be debanking, and we're determined to take a fresh look at that. In fact, I took the thing that you showed during the debanking hearing. When I saw that, we're now taking that out of the manual. So I thank you for that.
Thank you, Mr. Chairman. My time's up.
Senator Smith.
Thank you, Mr. Chair and Ranking Member, and thank you, Chair Powell, for being with us today. I appreciate your presence here. I'd like to start with the issue of the rising cost of home ownership, something that I know is of great interest to many of my colleagues on this committee. I know, Mr. Chair, that you care a lot about home ownership and making home ownership accessible and available to folks. My colleague, Senator Lummis, as well, many of the folks on my side of the aisle as well. And so I think this is something that we can agree on, that the rising cost of home ownership is a big challenge for our constituents, for Americans. And one of the big pressures, there are many, but one of the big pressures is the rising cost of home insurance. In Minnesota, families, seniors are struggling to manage a nearly 40% increase in home insurance rates. We've seen this over the last 7 years or so. And I know, Chair Powell, that you've told this committee in the past that rising cost of buying insurance for your home has been a source of inflation as we've been trying to manage inflation. Now, I don't know anyone who doesn't see this crisis of rising insurance rates as being caused by extreme weather events, where we've seen massive flooding in the southeastern United States. We've seen flooding in Minnesota. We've seen fires in the Mountain West in California. These are climate-related events. Then that's not a political position. That is just a fact. So, we've got banks that of course, require, understandably, that a homeowner provide insurance as a predicate for getting a mortgage. So there's a big question about what's going to happen when insurance becomes unaffordable, or in some parts of the country, just literally not available, and what impact that would have on the mortgage markets, on the value of American homes. Just last week, a new analysis from First Street showed that overall, the value of U.S. real estate could be reduced by $1.4 trillion, colleagues, over the next 30 years due to unaccounted for climate risk. That's the cost, the risk of not being able to afford home insurance because of these extreme weather events. And the prospect of trillions of dollars of property become uninsurable is clearly a recipe, it seems to me, for market instability, both in the rental as well as the mortgage market. So my question, Chair Powell, is, given these trends, how do you think the Fed and how do you think we should be thinking about the challenges that these events are going to pose to insurance markets and to the overall financial stability of the economy? I'm asking you to comment specifically on climate change, because I understand my colleagues on the other side of the aisle see that as a political question. It's more like what you see as the risk to financial stability here.
So let me quickly note that we don't regulate or supervise insurance companies for the most part, but we're seeing the same thing, which is both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage. There won't be ATMs. There won't, the banks won't have branches and things like that. Right. That's a possibility coming up down the road. It's not that the banks will stay there and keep making loans in the face of evidence of disaster, or that insurance companies will do right policies. They can cancel those policies every year.
Right.
So I think the risk is that they just won't be there and that people won't be able to get them. That's really the issue.
And it seems to me that that would be a massive source of instability in our economy overall if you were to see that kind of dramatic decline in home ownership, home values, not to mention the disruption that would occur if people literally couldn't be in their homes anymore.
So I think it's going to fall, if that happens, it'll fall on homeowners and
right.
residents, but it'll also fall on state and local governments, which you see happening now, where they're stepping in states where insurance is going away, private insurance. You're seeing states step in because they want those areas to remain prosperous. So I don't know that it's a financial stability issue, but it certainly will have significant economic consequences.
Well, certainly to try to figure out how to provide reinsurance as an example in the places where commercial insurance isn't available would be a massive impact on state budgets, if to follow your chain of thinking. And I know in this committee, I've heard some of my colleagues on both sides of the aisle talk about the challenges overall with flood insurance, just as an example, and the massive expense that would have for us as well. I raise this, colleagues, because I think that this is an important issue that we need to be paying attention to. I do think it has a fundamental impact on the overall health of our economy as we look not even down the road, but where we are right now. So I'm out of time. Thank you, Chair Powell. I have a question. You and I have talked quite frequently about my deep and keen interest in the Community Reinvestment Act, and I'll follow up with a question on that for the record.
Thank you. Thank you, Senator Smith. Senator Haggerty?
Thank you, Chairman Scott. Chairman Powell, it's good to see you here today. Welcome. I want to start by talking to you a bit about markets and inflation. Less than 6 months ago, you expressed some serious concerns about labor market weakness and the risk of persistent inflation. But since then, the FOMC has begun its easing cycle and cut its target rate by 100 basis points, as you mentioned in your opening remarks. Now in the January meeting, the FOMC has telegraphed that it felt both the labor market and inflation have reached a point where you're comfortable maintaining its target range. And my question is this: the recent market data, including last week's strong jobs report, indicate that the economy is on firm ground. Indeed, swaps markets have begun to price in fewer and fewer cuts this year. And I just wanted to talk broadly about these market conditions that you see. Do you see evidence of a higher neutral rate emerging at this point?
Yes, I mean, let me say there was a lot of reason to be concerned about downside risk in the labor market toward the middle of this year, but really that concern has diminished significantly. Labor market's very strong. I think the evidence is, my own view, and there are many different views on this, but is that the neutral rate will have risen meaningfully, very hard to be precise about it, from what it was. It was clearly very, very low before the pandemic. Extraordinarily low, historically so. But yes, I think it's moved up, and many of my colleagues on the FOMC feel that way too.
It certainly seems that way. I'd like to turn now to what seems to be a very popular topic right at this point, and that's the CFPB. In your response to Senator Britt's question earlier, you confirmed that when the CFPB submits quarterly funding requests, the Fed is not in a position to exercise any discretion over what the funds are used for. Is that correct?
As long as it's compliant with the law.
It just strikes me that the Fed is not in a position to hold the CFPB accountable for what it does or how it spends its money. Congress hasn't been allowed to hold the CFPB accountable for what it does or how it spends its money. It looks like no one has been able to hold the CFPB accountable at all. And now I hear, complaints coming from every corner, particularly from the other side, complaints about the excessive delegation of authority to a Republican CFPB director when this entity was intentionally created to be wholly unresponsive to elected officials. So I just find that quite rich. Before I close, I'd like to come to a point on climate, and particularly the Fed's forays into climate activism that have taken place over these past 4 years and the recent retrenchment that we've seen. It's one thing for the Fed to disassociate from its past climate activism in a press release, but to credibly claim that it's divorced itself from partisan climate policies, the Fed needs to do more than just issue statements. It needs to actually end its climate policies. The Fed's independence from politics is a headline topic at the moment, of course, and while much attention has been given to potential external pressures on the Fed, I think it's also critical that we scrutinize how the Fed's own regulation and supervision might be utilized to in some way politicize the institution. So when the central bank strays from its mandate by embracing partisan climate policies, the Fed embroils itself in controversial political debates and invites legitimate political scrutiny. So I just want to urge the Fed to refocus entirely on its core statutory mandates. I know it's a commitment that both you and I share, Mr. Chairman. Thank you for being here with us today.
Thank you.
Thank you.
Thank you.
Senator Warnock.
Thank you very much, Chairman Scott, and welcome again, Chairman Powell. I want to echo the words of Ranking Member Warren and so many of my colleagues today on DOGE and Project 2025's illegal attack on the Consumer Financial Protection Bureau. Certainly the Bureau was not created to be dismantled. And since its inception, the CFPB has been the only federal agency solely dedicated to protecting Americans' wallets and pocketbooks from scammers and predatory companies in financial services. The CFPB reduced costs for Americans, returning more than $21 billion to Americans who have been cheated since its inception. I want us to focus on that as folks are talking about chasing after waste and fraud and abuse. The CFPB has returned more than $21 billion to Americans. Make no mistake, this attack on the CFPB will increase costs for Americans, and it will give the green light to fraudsters and predatory actors seeking to cheat hardworking Americans. And so, Chairman Powell, thousands of Georgians of all political stripes have written into my office, and they are alarmed by an unelected billionaire and his hacksters' dangerous attempts to access Americans' private data and the Treasury Department's systems that control $6 trillion in annual payments to millions of American citizens, including Social Security, Medicare, and tax refunds. Quickly, yes or no, has Elon Musk or members of his team, to your knowledge, attempted to access the Fed's protected data and systems? Yes or no?
I don't
To your
believe so.
knowledge.
I don't believe so.
Okay, so will you commit to report to this committee, majority and minority, immediately should you become aware of any such attempt by Elon Musk or DOGE to pierce the Fed's independence or to access its protected systems?
Yes.
Thank you for that commitment. The Fed's latest monetary policy report states that the tight labor market has allowed employment and earnings gaps between Black and Hispanic Americans and white Americans to narrow. I was glad to see that many of the long-standing disparities in employment and wages by sex, race, ethnicity, and education have narrowed under the Biden administration. Some gaps have reached historic lows. Specifically, the employment gap for Black workers and white workers is near its lowest point in almost 50 years. That is the economy that the Trump administration is inheriting, a historic low in almost 50 years. Chair Powell, as you work to promote maximum employment, what steps will the Fed take to ensure that these equity gains are permanent?
So the best thing we can do is it's both of our mandates, really, because as you well know, high inflation hits people at the low end of the income spectrum first and most. And in addition to that, we know that the benefits of a strong labor market over time can be really visible and important in those communities as well. So we pursue our mandate. We keep our heads down, and it works out that is the single best thing we can do to foster, closing those gaps.
You pursue your mandate, you want to make sure that it's working. Would you agree that we still need good equity data to continue to narrow and close those gaps by race and gender?
I do think, we're always going to be in favor of good data at the Fed, and we do have quite a bit of that data on our website.
But if we don't have equity data, it'd be difficult to know, right?
Yes.
I'm glad to hear you still believe in the value of good equity data for economic policy making. It's better to fly with the data than to fly blind. I'm not sure what's so controversial about the data. And while I was disappointed to hear that the Federal Reserve, which is independent from the White House, had scrubbed a diversity and inclusion section from its website after President Trump's executive order, while also scrubbing data on the racial, ethnic, and gender makeup of its economists and researchers, I hope you will continue to ensure that the public has good data on how our economy is working or not working for historically marginalized Americans. I also hope you will reconsider your decisions around the whitewashing of the Fed's website. Chair Powell, as we think about the value of protecting data on the Black-white wealth gap or employment gap, I think it's important to understand what policymakers can learn from this data. Historically, from what you've seen in the data, historically, what types of economic events have caused the Black-white wealth gap or employment gap to widen?
Well, high inflation, downturns, you see generally just take the black unemployment rate, it generally moves at twice the speed of the white unemployment rate. So when it goes up faster, and when it comes down faster. But there is, at the end of the day, there's always been a gap, and we want to run a strong labor market, and we target overall labor market conditions for maximum employment. But one of the benefits of that is that gap comes down.
Thank you so much. We all know that fully deregulating our financial regulators like the CFPB, firing bank examiners at the FDIC, or weakening the Fed's supervisory capacity makes an economic shock or recession more likely. We know that this disproportionately impacts Black and Hispanic workers, and there are real consequences to weakening and eliminating financial regulations that keep us safe. Working people are the ones especially who suffer. So thank you so much, and I look forward to continuing to work with you to close these gaps.
Senator Bates is next.
Thank you, Mr. Chairman. Chair Powell, thank you for presenting your report to the committee today and for coming to meet with me last week in my office as well. The Federal Reserve has enormous power over Americans' ability to work and earn a living. And the Fed's interest rate decisions have an especially big impact on industries like manufacturing, which depend on big investments. Chair Powell, the Fed's data on manufacturing is still holding up nationally, but it doesn't look very good in the Chicago region, which includes most of my state in Indiana. The Beige Book says manufacturing jobs are declining and fewer people are buying manufactured products. It also says that steel demand is at a low level, auto production has slowed, and machinery orders are down. What does that say about the rest of the country? When manufacturing in the heartland slows, does that signal trouble for industries in other parts of the country?
It can. It doesn't always, but it certainly can. We watch the manufacturing sector. It's very important. Manufacturing jobs tend to be high productivity jobs. They're very important in our economy. But I would say over the last couple of years, manufacturing was pretty weak during years in which we had high GDP overall. Manufacturing is a smaller proportion of the economy than it used to be, but it's still extremely important.
Senator Reid asked you why free trade doesn't work when one of the giant players doesn't abide by the rules. The China shock is proof of that. The Fed has a mandate to maximize employment. How do you account for the whole industry that is repeatedly suffocated by unfair competition?
We don't do trade policy. We're not responsible for it. We don't comment on those who do trade policy. So we don't really have a role in focusing specifically on that. That really is left to those who have responsibility over trade.
Do you agree that a healthy manufacturing economy is important to a healthy overall U.S. economy, though?
I do.
I hope you had an opportunity to read Robert Lighthizer February 6th essay in the New York Times. He explains why a big trade imbalance between any two countries is harmful to citizens in both of those countries. How does the Fed take the trade deficit into account in your decision-making at all?
Again, we really don't. We're aware of it, but it's not something that directly affects our mandate goals.
So not at all?
No. I did read his book, by the way. I didn't read that editorial.
Fair enough. It is a good book as well. I want to get into tariffs. It's no secret that most conventional economists hate tariffs. But I want to note that Indiana gained manufacturing jobs during President Trump's first term with the 2018-2019 tariffs. Even though the economist's conventional wisdom is that tariffs will reduce jobs, do you commit to following the data and not prejudge any outcome?
Very much so, as we did in 2018-19.
Finally, my staff reviewed the research paper on tariffs in preparation for this hearing, and I want to point out one of them called The Employment Consequences of U.S. Trade Wars. Mr. Chairman, I'd like to enter this paper for the record. It found that the timing of tariffs are very important. It found that China's retaliation to President Trump's tariffs did hurt U.S. jobs, but if the U.S. had imposed tariffs on China much earlier in the 90s and early 2000s, it would have almost completely eliminated job losses due to the China shock. And I know you've said what you said before, but will you and your staff please take a look at this paper?
We certainly will. I imagine we already have, but I'd love to see it.
I appreciate that. Home ownership is an essential part of the American dream, but families are struggling to afford homes. In just 5 years, the price of a typical home in Indiana has gone up more than 60%. More than 3/4 of American families can't afford an average home in their neighborhood. How do the Fed decisions about monetary policy affect the ability of regular families to buy a home?
Most of what will have driven that increase will be about some of it's about local regulation, as you I'm sure know. It's also about just wages going up and costs of materials and things like that going up. And land costs and all that are going up a lot. The channel that through which we affect housing is, of course, interest rates. And right now, interest rates are still pretty high, but actually, mortgage rates are really not set at the Fed. Those are really key off of longer run things. Nonetheless, we're clearly having an effect on the housing market, and that'll unwind as we normalize policy. But we're still going to be faced with high insurance costs and high material costs and labor shortages and all the things that keep driving housing prices up across the country.
Thank you. My time has expired.
Next will be Senator Gallego.
Thank you, Mr. Chair. Mr. Powell, just kind of running along that vein of thought, the housing costs are one of the top concerns of my constituents in Arizona. From 2010 to 2022, rents in Arizona increased by 72%, and I wish wages were as increased to match, but they did not. And the average 30-year fixed mortgage rate has been above 6% for nearly 30 months. With very few rate cuts anticipated in the near future, potential cost increase from tariffs or imported construction materials, as well as the demand that we're going to see in terms of rebuilding from California and labor shortages, what do you think needs to happen to make housing more affordable in Arizona and the United States in general?
You know, housing policy and things to help housing supply are really in your wheelhouse, not ours. I do think the housing markets around the country are still suffering from the after effects of the pandemic. Once that's all the way through and short-term rates are down to normal, whatever the new normal level is, I think housing costs are still going to be high. I think it's still going to be expensive to build housing in many parts of the country where lots of the urban areas, the obvious places to build housing has happened. So I think it's a long-term. There's a short-term problem which will go away in coming years, but there's a longer term problem with housing availability, and that's going to be something that's not within our authorities or power to affect.
You know, one of the things that I've seen in Arizona is because we have people that are locked into mortgages at 2.9, 2.8%, and in order for them to move to the new house, they're going to have to essentially go and try to get quote unquote a bigger house, but the mortgage payment is going to be through the roof. And while I know the Fed doesn't set the mortgage rate, at the same time, one of the biggest drivers, obviously, of inflation, especially in places like Arizona, is housing costs. And then one of the biggest decisions essentially you make on whether or not to move rates is inflation, which is driven by housing costs. So we're in this kind of perpetual vicious circle in Arizona when it comes to interest rates. So I don't know what the answer to that is, but I just want to at least for there to be some understanding on that, because it's the reason we're not breaking out of this cycle is because the problem kind of feeds itself over and over and over again.
Yes, that's exactly what's going on. But it's not obvious, though, that lower rates would lead to lower housing inflation because, of course, that would increase housing demand. It would unlock people's, low mortgages, but that creates both a buyer and a seller. So it's not clear that would be something that would drive down housing inflation.
Well, my supposition, especially in places like Arizona, which is really growing fast, is that by increasing supply with lower rates, you end up essentially having more of a competitive market, so people will start moving and essentially bring down the overall cost. But moving on, so I've also heard from businesses in Arizona, they're concerned about the threat of economic stability in tariffs that are imposed on our key U.S. trade partners. How should we expect prices to move for basic items like tomatoes, peppers, cars, and the like if we place a 25% tariff on Mexico next month, as the president has threatened?
So, as you know, we don't do tariff policy and we don't do commentary on tariff policy. I think just generally, when somebody's got to pay the tariff, and it can be the exporter, it can be the importer, it can be a middleman and it
Somebody
can be a
pays for it,
consumer.
though.
Somebody does, but in some cases it doesn't reach the consumer much. In some cases it does, and it really does depend on facts that we haven't seen yet.
But that also contributes to some of the calculations on inflation overall.
It can, but it's
hard to predict.
There's a question of how persistent that would be and how large it would be.
So, and of course, I understand you're not here to specifically comment on trade policy.
You were listening to lawmakers in the Senate's Committee on Banking, Housing, and Urban Affairs ask questions of Fed Chair Jerome Powell following his semi-annual monetary policy address. We're back with some reaction to Powell's testimony. I'm Brad Smith alongside Madison Mills. Powell reiterating a cautious stance on rate cuts.
With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
Here to react, we've got John Hilsenrath, Senior Advisor at StoneX. John, good to have you here with us. He went on to say that at the same time, reducing that policy restraint too slowly or too little could unduly weaken economic activity and employment here. Just want to get your reaction to what we've heard in the tone from Jay Powell today in front of Congress.
Right. I mean, I think the story that comes out of today is that the Fed is on hold. There was some residual hope in the markets that the Fed might get soft enough inflation data to cut interest rates again, perhaps as early as March or April. It now looks like it's not going to happen until the middle of the year at the earliest. Not only is the inflation outlook uncertain, but the economic policy outlook is uncertain. And the Fed really wants to sit back and see how things play out for a few months before it makes any more moves on the chessboard.
Well, it's interesting because we await these comments with such bated breath, but then Powell is a master at leaving his options open. Did you get any hint of movement towards either a potential hike down the road or even just moving closer to taking a hike off the table from what Powell said today?
Well, the longer they stay on hold, the fewer opportunities they have to cut rates later in the year. So their decision to take a wait and see approach maybe lowers the odds a little bit for getting in the 2 rate cuts that they talked about in December for 2025. But it's still really early days. To be honest with you, the Powell has said that the Fed is data dependent. They're watching the data. I think what matters more than what he says over several hours today is going to be an inflation report that comes out in a few milliseconds at 8:30 tomorrow morning. The Labor Department is reporting consumer price inflation data, and it's going to be the data that really dictate whether and when the Fed goes again. And this report that comes out tomorrow morning, the CPI report, is really important because in the last few years, a lot of the big increases that we've seen in prices have happened early in the year. That's when companies are doing their resets. So we'll get some important indication, I think, tomorrow morning about whether we're on maybe a lower glide path for inflation going into 2025. That's going to matter a lot to Jay Powell. He didn't give any indication today of whether he kind of knows or expects what's going to be in those numbers.
So with regard to that, Powell also answered questions on President Donald Trump's trade policies. I want to play this clip and get your reaction.
It's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
And so, John, what we've continued to hear from economists that we speak with is that tariffs, to be clear, are inflationary when you do have some of the tit for tat that goes back and forth and there's more prolonged tariffs on the table here. I wonder your assessment and how long the Fed is willing to wait in order for them to be able to see the economic ingestion of that tariff activity.
So I'll say 2 things, one about tariffs and one about Jay Powell on his playbook for dealing with the president. In terms of tariffs, I think we have to be careful when we talk about tariffs and their effect on inflation about exactly what we mean. So there's an inflation rate and there's a price level, right? So the inflation rate is how fast prices are going up on an ongoing regular basis. What a tariff does is it increases the price of certain goods or services. It increases the price of imported steel or the price of cars. But that's a one-time price shock. It's not necessarily a permanent increase in the rate of inflation. So whether that changes over the long run, the rate of inflation, I think is a little bit more heavily debated among economists. I think perhaps tariffs are a little inflationary because they undermine the kind of global system that's kept the inflation rate low. But I think the Fed has a mind that's open to the possibility that tariffs would be a one-time shock and not a permanent diminishment of their ability to get that 2% inflation rate every year, year in and year out. In terms of how Powell approaches these things, he has a playbook. He developed this playbook during the president's first term in office. And that playbook is stay focused on his mission. Powell wants to stay focused on his mission. That mission is a 2% inflation rate and low and stable unemployment. So he doesn't want to get into the president's business, in part because he doesn't want the president to get into his business. So he's just not going to answer those questions. Even though these policies create uncertainty for the Fed and they want to see how things play out, they don't feel like they should be playing the role of the sideline commentator, telling the president and in effect voters exactly what policies, economic policies, they should put in place.
And before we wrap, just want to get your thoughts heading into CPI tomorrow. Of course, a key reading on inflation that the Federal Reserve looks at. What are you thinking heading into that print, and what do you think that print could mean for the Fed moving forward?
Well, so, with these things, you have to go with a little bit of a gut sometimes. I mean, we know that, for instance, gasoline prices haven't moved much over the last couple of months. We know that food prices are up in areas like eggs. So those are the volatile categories. We might see some movement on the food side and the overall inflation side from that. In terms of core, everything else that's happening in the economy, I think that we've seen in the last couple of reports a little bit of softness that's been encouraging. And I think if we see some more softness in the inflation data this time around, then the market's going to be really pleased by that, and it'll be putting a mid-year rate cut back on the table. And I'll say one other thing. These reports are really important kind of across the board in financial markets. We've moved to this period where when it comes to inflation, good news is good news for everybody. It pushes down bond yields. It pushes up stock prices. It strengthens the dollar. There are certain times when, like if you see a weak jobs report, you say, well, like, why are stock prices going down when jobs are going up?
Right.
And that might be because people see inflationary problems. When these inflation reports come in around where the Fed wants them,
John, we gotta wrap.
News day.
We gotta head out, but thank you
you
so much. Really appreciate you joining us today.
That's it for us, everyone.
Gotcha.
I'm Brad Smith alongside Madison Mills. Thank you so much for watching. Stay tuned. Market Domination, 3 p.m.
Time for Yahoo Finance's Market Minute. Stocks mixed after Fed Chair Jay Powell says the Fed is in no hurry to cut interest rates. Shares of Shopify wavering after beating estimates for its fourth quarter. Analysts point to somewhat disappointing cash flow guidance as a potential catalyst for the street's muted reaction to Shopify's results. Coca-Cola shares higher. Its profit beat expectations in its latest quarter as consumers continue to spend on sodas, energy drinks, and juices even amid higher prices. And Humana shares are lower after its forecasts were flat for earnings for full year 2025. The company also saying it expects Medicare Advantage memberships to fall by about 10% year over year as it moves out of areas it believes are unprofitable. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.